Welcome back to Trading for Life and part 2 of the audiobook, How to Make Money in Stocks by William J. O'Neil. In this section, we dive into chapters 10 through 13, where O'Neil builds on his proven can-slim strategy and provides powerful insights for successful investing. Here is part 2.
Part 2, Be Smart from the Start. Chapter 10, When You Must Sell and Cut Every Loss Without Exception. Now that you've learned how and when to buy nothing but the best stocks, it's time for you to learn how and when to sell them. You've probably heard the sports cliché, the best defense is a strong defense. The funny thing about clichés is they are usually true. A team that's all offense and no defense seldom wins the game. In fact, a strong defense can often propel a team to great heights. During their heyday, when Branch Rickey was president and general manager, the Brooklyn Dodgers typically had good pitching. In the game of baseball, the combination of pitching and fielding represents the defensive side of a team and probably 70% of the game. It's almost impossible to win without them. The same holds true in the stock market. Unless you have a strong defense to protect yourself against large losses, you absolutely can't win big in the game of investing. Bernard Baruch's secret market method of making millions. Bernard Baruch, a famous market operator on Wall Street and a trusted advisor to U.S. presidents, said it best: if a speculator is correct half of the time, he is hitting a good average. Even being right 3 or 4 times out of 10 should yield a person a fortune if he has the sense to cut his losses quickly on the ventures where he has been wrong. As you can see, even the most successful investors make many mistakes. These poor decisions will lead to losses, some of which can become quite awful if you're not disciplined and careful. No matter how smart you are, how high your IQ, how advanced your education, how good your information, or how sound your analysis, you're simply not going to be right all the time. In fact, you'll probably be right less than half the time. You positively must understand and accept that the first rule for the highly successful individual investor is always cut short and limit every single loss. To do this takes never-ending discipline and courage. Mark Mandel of Winning on Wall Street has been reading Investors Business Daily since 1987. He likes it for its many money-making ideas and its emphasis on risk management strategies. Lose small and win big, he believes, is the holy grail of investing. Baruch's point about cutting losses was driven home to me by an account that I managed back in 1962. The general market had taken a 29% nosedive, and we were right on only one of every 3 commitments we had made in this account. Yet at the end of the year, the account was ahead. The reason was that the average profit on the 33% of decisions that were correct was more than twice the average of the small losses we took when we were off target. I like to follow a 3-to-1 ratio between where to sell and take profits and where to cut losses. If you take some 20% to 25% gains, cut your losses at 7% or 8%. If you're in a bear market like 2008 and you buy any stocks at all, you might get only a few 10% or 15% gains, so I'd move quickly to cut every single loss automatically at 3%, with no exceptions. The whole secret to winning big in the stock market is not to be right all the time, but to lose the least amount possible when you're wrong. You've got to recognize when you may be wrong and sell without hesitation to cut short every one of your losses. It's your job to get in phase with the market and not try to get the market to be in phase with you. How can you tell when you may be wrong? That's easy. The price of the stock drops below the price you paid for it. Each point that your favorite brainchild falls below your cost increases both the chance that you're wrong and the price that you're going to pay for being wrong. Are successful people lucky or always right? People think that in order to be successful, you have to be either lucky or right most of the time. Not so. Successful people make many mistakes, and their success is due to hard work, not luck. They just try harder and more often than the average person. There aren't many overnight successes. Success takes time. In search of a filament for his electric lamp, Thomas Edison carbonized and tested 6,000 specimens of bamboo. 3 of them worked. Before that, he had tried thousands of other materials, from cotton thread to chicken feathers. Babe Ruth worked so hard for his home run record that he also held the lifetime record for strikeouts. Irving Berlin wrote more than 600 songs, but no more than 50 were hits. The Beatles were turned down by every record company in England before they made it big. Michael Jordan was once cut from his high school basketball team, and Albert Einstein made an F in math. It also took him many years to develop and prove his theory of relativity. It takes a lot of trial and error before you can nail down substantial gains in stocks like Brunswick and Great Western Financial when they doubled in 1961. Chrysler and Syntex in 1963, Fairchild Camera and Polaroid in 1965, Control Data in 1967, Levitt's Furniture in 1972, Prime Computer and Humana in 1977, 1981, MCI Communications in 1981-1982, Price Company in 1982-1983, Microsoft in 1986-1992, Amgen in 1990-1991. International Game Technology in 1991-1993, Cisco Systems from 1995 to 2000, America Online and Charles Schwab in 1998-1999, and Qualcomm in 1999. These stocks dazzled the market with gains ranging from 100% to more than 1,000%. Over the years, I've found that only 1 or 2 out of 10 stocks that I've bought turned out to be truly outstanding and capable of making this kind of substantial profits. In other words, to get the 1 or 2 stocks that make big money, you have to look for and buy 10. Which begs the question, what do you do with the other 8? Do you sit with them and hope, the way most people do? Or do you sell them and keep trying until you come up with even bigger successes? When does a loss become a loss? When you say, I can't sell my stock because I don't want to take a loss, you assume that what you want has some bearing on the situation. But the stock doesn't know who you are, and it couldn't care less what you hope or want. Besides, selling doesn't give you the loss, you already have the loss. If you think you haven't incurred a loss until you sell the stock, you're kidding yourself. The larger the paper loss, the more real it will become. If you paid $40 per share for 100 shares of Can't Miss Chemical, and it's now worth $28 per share, you have $2,800 worth of stock that cost you $4,000. You have a $1,200 loss. Whether you convert the stock to cash or hold it, it's still worth only $2,800. Even though you didn't sell, you took your loss when the stock dropped in price. You'd be better off selling and going back to a cash position where you can think far more objectively. When you're holding on to a big loss, you're rarely able to think straight. You get emotional. You rationalize and say, it can't go any lower. However, keep in mind that there are many other stocks to choose from where your chance of recouping your loss could be greater. Here's another suggestion that may help you decide whether to sell. Pretend that you don't own the stock and you have $2,800 in the bank. Then ask yourself, do I really want to buy this stock now? If your answer is no, then why are you holding on to it? Always, without exception, limit losses to 7% or 8% of your cost. Individual investors should definitely set firm rules limiting the loss on the initial capital they have invested in each stock to an absolute maximum of 7% or 8%. Institutional investors who lessen their overall risk by taking large positions and diversifying broadly are unable to move into and out of stocks quickly enough to follow such a loss-cutting plan. This is a terrific advantage that you, the nimble and decisive individual investor, have over the institutions. So use it. When the late Gerald M. Loeb of E.F. Hutton was writing his last book on the stock market, he came down to visit me, and I had the pleasure of discussing this idea with him. In his first work, The Battle for Investment Survival, Loeb advocated cutting all losses at 10%. I was curious and asked him if he always followed the 10% loss policy himself. I would hope, he replied, to be out long before they ever reach 10%. Loeb made millions in the market. Bill Astrop, president of Astrop Advisory Corp. in Atlanta, Georgia, suggests a minor revision of the 10% loss-cutting plan. He thinks that individual investors should sell half of their position in a stock if it is down 5% from their cost, and the other half once it's down 10%. This is sound advice. To preserve your hard-earned money, I think a 7% or 8% loss should be the limit. The average of all your losses should be less, perhaps 5% or 6%, if you're strictly disciplined and fast on your feet. If you can keep the average of all your mistakes and losses to 5% or 6%, you'll be like the football team on which opponents can never move the ball. If you don't give up many first downs, how can anyone ever beat you? Now, here's a valuable secret. If you use charts to time your buys precisely off sound bases, price consolidation areas, your stocks will rarely drop 8% from a correct buy point. So when they do, either you've made a mistake in your selection or a general market decline may be starting. This is a big key to your future success. Barbara James, an IBD subscriber who has attended several of our workshops, didn't know anything about stocks when she started investing after 20 years in the real estate business. She first traded on paper using the IBD rules. This worked so well that she finally had the confidence to try it with real money. That was in the late 1990s, when the market seemed to have only one direction, up. The first stock she bought using the IBD rules was EMC. When she sold it in 2000, she had a 1,300% gain. She also had a gain of over 200% in gap. 10 years after her start, with the profits she made using IBD, she was able to pay off her house and her car. And thanks to the 7% rule, Barbara can take advantage of the market once it improves. Before the market started to correct in the fall of 2007, she had bought 3 Slim stocks: Monolithic Power, China Medical, and St. Jude Medical. I bought them all at exactly the right pivot point, and I got forced out of all 3 as the market started to correct in July and August, she says. I'm happy to lose money when it's only 7% or 8%. If it hadn't been for the sell rules, I would have lost my shirt, and I wouldn't have resources for the next bull market. Here's what another IBD subscriber, Herb Mitchell, told us in February 2009. Over and over again, the buy and sell rules, especially the sell rules, have been proven to work. It took me a couple of years to finally get it through my head, but then the results started to show. I spent most of 2008 on the sidelines, and I now get compliments from friends who say that they lost thousands, 50% or more, in their IRA accounts, while I had a 5% gain for the year. I think I should have done better, but you live and learn. Also, there's no rule that says you have to wait until every single loss reaches 7% to 8% before you take it. On occasion, you'll sense the general market index is under distribution selling, or your stock isn't acting right and you are starting off amiss. In such cases, you can cut your loss sooner when the stock may be down only 1 or 2 points. Before the market broke wide open in October 1987, for example, there was ample time to sell and cut losses short. A correction actually began on August 26. If you're foolish enough to try bucking the market by buying stocks in bearish conditions, at least move your absolute loss cutting point up to 3% or 4%. After years of experience with this technique, your average losses should become less as your stock selection and timing improve, and you learn to make small, follow-up buys in your best stocks. It takes a lot of time to learn to make follow-up buys safely when a stock is up, but this method of money management forces you to move your money from slower-performing stocks into your stronger ones. I call this force feeding. See my revised profit and loss plan in Chapter 11. You'll end up selling stocks that are not yet down 7% or 8% because you are raising money to add to your best winners during clearly strong bull markets. Remember, 7% to 8% is your absolute loss limit. You must sell without hesitation, no waiting a few days to see what might happen, no hoping that the stock will rally back, no need to wait for the day's market close. Nothing but the fact that you're down 7% or 8% below your cost should have a bearing on the situation at this point. Once you're significantly ahead and have a good profit, you can afford to give the stock a good bit more room for normal fluctuations off its price peak. Do not sell a stock just because it's off 7% to 8% from its peak price. It's important that you definitely understand the difference. In one case, you probably started off wrong. The stock is not acting the way you expected it to, and it is down below your purchase price. You're starting to lose your hard-earned money, and you may be about to lose a lot more. In the other case, you have begun correctly. The stock has acted better, and you have a significant gain. Now you're working on a profit, so in a bull market, you can afford to give the stock more room to fluctuate so that you don't get shaken out on a normal 10% to 15% correction. Don't chase your stock up too far when you're buying it, however. Key is timing your stock purchases exactly at breakout points to minimize the chance that a stock will drop 8%. See Chapter 2 for more on using charts to select stocks. All common stocks are speculative and risky. There is considerable risk in all common stocks, regardless of their name, quality, purported blue chip status, previous performance record, or current good earnings. Keep in mind that growth stocks can top at a time when their earnings are excellent and analysts' estimates are still rosy. There are no sure things or safe stocks. Any stock can go down at any time, and you never know how far it can go down. Every 50% loss began as a 10% or 20% loss. Having the raw courage to sell and take your loss cheerfully is the only way you can protect yourself against the possibility of much greater losses. Decision and action should be instantaneous and simultaneous. To be a big winner, you have to learn to make decisions. I've known at least a dozen educated and otherwise intelligent people who were completely wiped out solely because they would not sell and cut a loss. What should you do if a stock gets away from you and the loss becomes greater than 10%? This can happen to anyone, and it's an even more critical sign that the stock positively must be sold. The stock was in more trouble than normal, so it fell faster and further than normal. In the market collapse of 2000, many new investors lost heavily, and some of them lost it all. If they had just followed the simple sell rule discussed earlier, they would have protected most of their capital. In my experience, the stocks that get away from you and produce larger than normal losses are the truly awful selections that absolutely must be sold. Something is really going wrong with either the stock or the whole market, and it's even more urgent that the stock be sold to avoid a later catastrophe. Keep in mind that if you let a stock drop 50%, you must make 100% on your next stock just to break even. And how often do you buy stocks that double? You simply can't afford to sit with a stock where the loss keeps getting worse. It is a dangerous fallacy to assume that because a stock goes down, it has to come back up. Many don't. Others take years to recover. AT&T hit a high of $75 in 1964 and took 20 years to come back. Also, when the S&P 500 or Dow declines 20% to 25% in a bear market, many stocks will plummet 60% to 75%. If the S&P dives 52%, as it did in 2008, some stocks can fall 80% to 90%. Who would have projected that General Motors would sell for $2 a share, down from $94? The auto industry is important to the United States, but it will require a serious, top-to-bottom restructuring, and will possibly have to go through bankruptcy if it is to survive and compete effectively in the highly competitive world market. For 14 years, from 1994 to 2008, GM stock's relative price strength line declined steadily. What will GM do in the future if India or China sells cars in the United States that get 50 miles per gallon and have a much lower price? The only way to prevent bad stock market losses is to cut them without hesitation while they're still small. Always protect your account so that you can live to invest successfully another day. In 2000, many new investors incorrectly believed that all you had to do was buy high-tech stocks on every dip in price because they would always go back up, and there was easy money to be made. This is an amateur's strategy, and it almost always leads to heavy losses. Semiconductor and other technology stocks are 2 to 3 times as volatile and risky as others. So if you're in these stocks, moving rapidly to cut short every loss is even more essential. If your portfolio is in nothing but high-tech stocks, or if you're heavily margined in tech stocks, you are asking for serious trouble if you don't cut your losses quickly. You should never invest on margin unless you're willing to cut all your losses quickly. Otherwise, you could go belly up in no time. If you get a margin call from your broker, when you're faced with the decision to either sell stock or add money to your account to cover the lost equity in a falling stock, don't throw good money after bad. Sell some stock and recognize what the market and your margin clerk are trying to tell you. Cutting losses is like buying an insurance policy. This policy of limiting losses is similar to paying insurance premiums. You're reducing your risk to precisely the level you're comfortable with. Yes, the stock you sell will often turn right around and go back up. And yes, this can be frustrating. But when this happens, don't conclude that you were wrong to sell it. That is exceedingly dangerous thinking that will eventually get you into big trouble. Think about it this way. If you bought insurance on your car last year and you didn't have an accident, was your money wasted? Will you buy the same insurance this year? Of course you will. Did you take out fire insurance on your home or your business? If your home or business hasn't burned down, are you upset because you feel that you made a bad financial decision? No. You don't buy fire insurance because you know your house is going to burn down. You buy insurance just in case, to protect yourself against the remote possibility of a serious loss. It's exactly the same for the winning investor who cuts all losses quickly. It's the only way to protect against the possible or probable chance of a much larger loss from which it may not be possible to recover. If you hesitate and allow a loss to increase to 20%, you will need a 25% gain just to break even. Wait longer until the stock is down 25%, and you'll have to make 33% to get even. Wait still longer until the loss is 33%, and you'll have to make 50% to get back to the starting gate. The longer you wait, the more the math works against you, so don't vacillate. Move immediately to cut out possible bad decisions. Develop the strict discipline to act and to always follow your selling rules. Some people have gone so far as to let losing stocks damage their health. In this situation, it's best to sell and stop worrying. I know a stockbroker who in 1961 bought Brunswick at $60 on the way down in price. It had been the market's superleader since 1957, increasing more than 20 times. When it dropped to $50, he bought more, and when it dropped to $40, he added again. When it dropped to $30, he dropped dead on the golf course. History and human nature keep repeating themselves in the stock market. In the fall of 2000, many investors made the identical mistake. They bought the prior bull market's leader, Cisco Systems, on the way down at $70, $60, $50, and lower after it had topped at $87. 7 months later, it had sunk to $13, an 80% decline for those who bought at $70. Moral of the story is, never argue with the market. Your health and peace of mind are always more important than any stock. Small losses are cheap insurance, and they're the only insurance you can buy on your investments. Even if a stock moves up after you sell it, as many surely will, you will have accomplished your critical objective of keeping all your losses small, and you'll still have money to try again for a winner in another stock. Take your losses quickly and your profits slowly. There's an old investment saying that the first loss in the market is the smallest. In my view, the way to make investment decisions is to always, with no exceptions, take your losses quickly and your profits slowly. Yet most investors get emotionally confused and take their profits quickly and their losses slowly. What is your real risk in any stock you buy when you use the method we've discussed? It's 8%, no matter what you buy, if you follow this rule religiously. Still, most investors stubbornly ask, shouldn't we sit with stocks rather than selling and taking a loss? Or, how about unusual situations where some bad news hits suddenly and causes a price decline? Or, does this loss-cutting procedure apply all the time, or are there exceptions, like when a company has a good new product? The answer, there are no exceptions. None of these things changes the situation one bit. You must always protect your hard-earned pool of capital. Letting your losses run is the most serious mistake that almost all investors make. You must accept the fact that mistakes in stock selection and timing are going to be made frequently, even by the most experienced of professional investors. I'd go so far as to say that if you aren't willing to cut short and limit your losses, you probably shouldn't buy stocks. Would you drive your car down the street without brakes? If you were a fighter pilot, would you go into battle without a parachute? Should you average down in price? One of the most unprofessional things a stockbroker can do is hesitate or fail to call customers whose stocks are down in price. That's when the customer needs help the most. Shirking this duty in difficult periods shows a lack of courage under pressure. About the only thing that's worse is for brokers to take themselves off the hook by advising customers to average down, buy more of a stock that is already showing a loss. If I were advised to do this, I'd close my account and look for a smarter broker. Everyone loves to buy stocks. No one loves to sell them. As long as you hold a stock, you can still hope it might come back up enough to at least get you out even. Once you sell, you abandon all hope and accept the cold reality of temporary defeat. Investors are always hoping rather than being realistic. Knowing and acting is better than hoping or guessing. The fact that you want a stock to go up so you can at least get out even has nothing to do with the action and brutal reality of the market. The market obeys only the law of supply and demand. Great trader once noted there are only two emotions in the market, hope and fear. The only problem, he added, is we hope when we should fear and we fear when we should hope. This is just as true in 2009 as it was in 1909. The turkey story. Many years ago, I heard a story by Fred C. Kelly, the author of Why You Win or Lose, that illustrates perfectly how the conventional investor thinks when the time comes to make a selling decision. Little boy was walking down the road when he came upon an old man trying to catch wild turkeys. The man had a turkey trap, a crude device consisting of a big box with the door hinged at the top. This door was kept open by a prop, to which was tied a piece of twine leading back 100 feet or more to the operator. A thin trail of corn scattered along a path lured turkeys to the box. Once they were inside, the turkeys found an even more plentiful supply of corn. When enough turkeys had wandered into the box, the old man would jerk away the prop and let the door fall shut. Having once shut the door, he couldn't open it again without going up to the box, and this would scare away any turkeys that were lurking outside. The time to pull away the prop was when as many turkeys as one could reasonably expect were inside. One day he had a dozen turkeys in his box, then one sauntered out, leaving 11. "Gosh, I wish I had pulled the string when all 12 were there," said the old man. "I'll wait a minute and maybe the other one will go back." While he waited for the 12th turkey to return, 2 more walked out on him. "I should have been satisfied with 11, the trapper said. "Just as soon as I get one more back, I'll pull the string." 3 more walked out, and still the man waited. Having once had 12 turkeys, he disliked going home with less than 8. He couldn't give up the idea that some of the original turkeys would return. When finally there was only 1 turkey left in the trap, he said, "I'll wait until he walks out or another goes in, and then I'll quit." The solitary turkey went to join the others, and the man returned empty-handed. The psychology of normal investors is not much different. Hope more turkeys will return to the box when they should fear that all the turkeys could walk out and they'll be left with nothing. How the typical investor thinks. If you're a typical investor, you probably keep records of your transactions. When you think about selling a stock, you probably look at your records to see what price you paid for it. If you have a profit, you may sell, but if you have a loss, you tend to wait. After all, you didn't invest in the market to lose money. However, what you should be doing is selling your worst performing stock first. Keep your flower patch free of weeds. You may decide to sell your shares in Myriad Genetics, for example, because it shows a nice profit, but you'll keep your General Electric because it still has a ways to go before it's back to the price you paid for it. If this is the way you think, you're suffering from the price-paid bias that afflicts 95% of all investors. Suppose you bought a stock 2 years ago at $30 and it's now worth $34. Most investors would sell it because they have a profit. But what does the price you paid 2 years ago have to do with what the stock is worth now? And what does it have to do with whether you should hold or sell the stock? The key is the relative performance of this stock versus others you either own or could potentially own. Analyzing your activities. To help you avoid the price-paid bias, particularly if you are a longer-term investor, I suggest you use a different method of analyzing your results. At the end of each month or quarter, compute the percentage change in the price of each stock from the last date you did this type of analysis. Now list your investments in order of their relative price performance since your previous evaluation period. Let's say Caterpillar is down 6%, ITT is up 10%, and General Electric is down 10%. Your list would start with ITT on top, then Caterpillar, then GE. At the end of the next month or quarter, do the same thing. After a few reviews, you will easily recognize the stocks that are not doing well. They'll be at the bottom of the list. Those that did best will be at or near the top. This method isn't foolproof, but it does force you to focus your attention not on what you paid for your stocks, but on the relative performance of your investments in the market. It will help you maintain a clearer perspective. Of course, you have to keep records of your costs for tax reasons, but you should use this more realistic method in the longer-term management of your portfolio. Doing this more often than once a quarter can only help you. Eliminating the price-paid bias can be profitable and rewarding. Anytime you make a commitment to a security, you should also determine the potential profit and possible loss. This is only logical. You wouldn't buy a stock if there were a potential profit of 20% and a potential loss of 80%, would you? But if you don't try to define these factors and operate by well-thought-out rules, how do you know this isn't the situation when you make your stock purchase? Do you have specific selling rules you've written down and follow, or are you flying blind? I suggest you write down the price at which you expect to sell if you have a loss, 8% or less below your purchase price, along with the expected profit potential of all the securities you purchase. For instance, you might consider selling your growth stock when its P/E ratio increases 100% or more from the time the stock originally began its big move out of its initial base pattern. If you write these numbers down, you'll more easily see when the stock has reached one of these levels. It's bad business to base your sell decisions on your cost and hold stocks down in price simply because you can't accept the fact you made an imprudent selection and lost money. In fact, you're making the exact opposite decisions from those you would make if you were running your own business. Red dress story. Investing in the stock market is really no different from running your own business. Investing is a business and should be operated as such. Assume that you own a small store selling women's clothing. You've bought and stocked women's dresses in 3 colors, yellow, green, and red. The red dresses go quickly, half the green ones sell, and the yellows don't sell at all. What do you do about it? Do you go to your buyer and say, the red dresses are all sold out, the yellow ones don't seem to have any demand, but I still think they're good. Besides, yellow is my favorite color, so let's buy some more of them anyway. Certainly not. The clever merchandiser who survives in the retail business looks at this predicament objectively and says, we sure made a mistake. You'd better get rid of the yellow dresses. Let's have a sale. Mark them down 10%. If they don't sell at that price, mark them down 20%. Let's get our money out of those old dogs no one wants and put it into more of the hot moving red dresses that are in demand. This is common sense in any retail business. Do you do this with your investments? Why not? Everyone makes buying errors. Buyers for department stores are pros, but even they make mistakes. If you do slip up, recognize it, sell, and go on to the next thing. You don't have to be correct on all your investment decisions to make a good net profit. Now you know the real secret to reducing your risk and selecting the best stocks. Stop counting your turkeys and get rid of your yellow dresses. Are you a speculator or an investor? There are two often misunderstood words that are used to describe the kinds of people who participate in the stock market: speculator and investor. When you think of the word speculator, you might think of someone who takes big risks, gambling on the future success of a stock. Conversely, when you think of the word investor, you might think of someone who approaches the stock market in a sensible and rational manner. According to these conventional definitions, you may think it's smarter to be an investor. Baruch, however, defined speculator as follows. The word speculator comes from the Latin speculare, which means to spy and observe. A speculator, therefore, is a person who observes and acts before occurs. This is precisely what you should be doing, watching the market and individual stocks to determine what they're doing now, and then acting on that information. Jesse Livermore, another stock market legend, defined investor this way: investors are the big gamblers. They make a bet, stay with it, and if it goes wrong, they lose it all. After reading this far, you should already know this is not the proper way to invest. There's no such thing as a long-term investment once a stock drops into the loss column and you're down 8% below your cost. These definitions are a bit different from those you'll read in Webster's dictionary, but they are far more accurate. Keep in mind that Baruch and Livermore at many times made millions of dollars in the stock market. I'm not sure about lexicographers. One of my goals is to get you to question many of the faulty investment ideas, beliefs, and methods that you've heard about or used in the past. One of these is the very notion of what it means to invest. It's unbelievable how much erroneous information about the stock market, how it works, and how to succeed at it is out there. Learn to objectively analyze all the relevant facts about a stock and about how the market is behaving. Stop listening to and being influenced by friends, associates, and the continuous array of experts' personal opinions on daily TV shows. For safety, why not diversify widely? Wide diversification is a substitute for lack of knowledge. It sounds good, and it's what most people advise. But in a bad bear market, almost all of your stocks will go down, and you could lose 50% or more in some stocks that will never come back. So diversification is a poor substitute for a sound defensive plan with rules to protect your account. Also, if you have 20 or 30 stocks and you sell 3 or 4, it won't help you when you lose heavily on the rest. I'm not worried. I'm a long-term investor, and I'm still getting my dividends. It's also risky and possibly foolish to say to yourself, I'm not worried about my stocks being down because they are good stocks, and I'm still getting my dividends. Good stocks bought at the wrong time can go down as much as poor stocks, and it's possible they might not be such good stocks in the first place. It may just be your personal opinion they're good. Furthermore, if a stock is down 35% in value, isn't it rather absurd to say you're all right because you are getting a 4% dividend yield? 35% loss plus a 4% income gain equals a whopping 31% net loss. To be a successful investor, you must face facts and stop rationalizing and hoping. No one emotionally wants to take losses, but to increase your chances of success in the stock market, you have to do many things you don't want to do. Develop precise rules and hard-nosed selling disciplines, and you'll gain a major advantage. Never lose your confidence. There's one last critical reason for you to take losses before they have a chance to really hurt you. Never lose your courage to make decisions in the future. If you don't sell to cut your losses when you begin to get into trouble, you can easily lose the confidence you'll need to make buy and sell decisions in the future. Or far worse, you can get so discouraged that you finally throw in the towel and get out of the market, never realizing what you did wrong, never correcting your faulty procedures, and giving up all the future potential the stock market, one of the most outstanding opportunities in America, has to offer. Wall Street is human nature on daily display. Buying and selling stocks properly and making a net profit are always a complicated affair. Human nature being what it is, 90% of people in the stock market, professionals and amateurs alike, simply haven't done much homework. They haven't really studied to learn whether what they're doing is right or wrong. They haven't studied in enough detail what makes a successful stock go up and down. Luck has nothing to do with it, and it's not a total mystery. And it certainly isn't a random walk or an efficient market, as some inexperienced university professors formerly believed. It takes some work to become really good at stock selection, and still more to know how and when to sell. Selling a stock correctly is a tougher job and the one that is least understood by everyone. To do it right, you need a plan to cut losses and the discipline to do this quickly without wavering. Forget your ego, swallow your pride, stop trying to argue with the market, and don't get emotionally attached to any stock that's losing you money. Remember, there are no good stocks. They're all bad unless they go up in price. Learn from the 2000 and 2008 experience. Those who followed our selling rules protected their capital and nailed down gains. Those who did not have or follow any selling rules got hurt. Chapter 11, When to Sell and Take Your Worthwhile Profits. This is one of the most vital chapters in this book, covering an essential subject few investors handle well, so study it very carefully. Common stock is just like any other merchandise. You, as the merchant, must sell your stock if you're to realize a profit, and the best way to sell a stock is when it's on the way up, while it's still advancing and looking strong to everyone else. This may be contrary to your human nature, because it means selling when your stock is strong, is up a lot in price, and looks like it could make even more profit for you. But if you do this, you won't get caught in the heartrending 20% to 40% corrections that can hit market leaders and put downside pressure on your portfolio. You'll never sell at the exact top, so don't kick yourself if a stock goes still higher after you sell. If you don't sell early, you'll be late. The object is to make and take significant gains and not get excited, optimistic, greedy, or emotionally carried away as your stock's advance gets stronger. Keep in mind the old saying, bulls make money and bears make money, but pigs get slaughtered. The basic objective of every account should be to show a net profit. To retain worthwhile profits, you must sell and take them. The key is knowing when to do just that. Bernard Baruch, the financier who built a fortune in the stock market, said, "Repeatedly, I have sold a stock while it was still rising, and that has been one reason why I have held on to my fortune. Many a time, I might have made a good deal more by holding a stock, but I would also have been caught in the fall when the price of the stock collapsed." When asked if there was a technique for making money on the stock exchange, Nathan Rothschild, the highly successful international banker, said, "There certainly is. I never buy at the bottom and I always sell too soon." Joe Kennedy, one-time Wall Street speculator and father of former President John F. Kennedy, believed only a fool holds out for the top dollar. The object, he said, is to get out while a stock is up before it has a chance to break and turn down. And Gerald M. Loeb, a highly successful financier, stressed once the price has risen into estimated normal or overvaluation areas, the amount held should be reduced steadily as quotations advance. What all these Wall Street legends believed was this: you simply must get out while the getting is good. The secret is to hop off the elevator on one of the floors on the way up and not ride it back down again. You must develop a profit and loss plan. To be a big success in the stock market, you need definite rules and a profit and loss plan. I developed many of the buy and sell rules described in this book in the early 1960s, when I was a young stockbroker with Hayden Stone. These rules helped me buy a seat on the New York Stock Exchange and start my own firm shortly thereafter. When I started out, though, I concentrated on developing a set of buy rules that would locate the very best stocks. But as you'll see, I had only half of the puzzle figured out. My buy rules were first developed in January 1960, when I analyzed the 3 best-performing mutual funds of the prior 2 years. Standout was the then small Dreyfus Fund, which racked up gains twice as large as those of many of its competitors. I sent away for copies of every Dreyfus quarterly report and prospectus from 1957 to 1959. Then, I calculated the average cost of each new stock the fund had purchased. Next, I got a book of stock charts and marked in red the average price Dreyfus had paid for its new holdings each quarter. After looking at more than 100 new Dreyfus purchases, I made a stunning discovery. Every stock had been bought at the highest price it had sold for in the past year. In other words, if a stock had bounced between $40 and $50 for many months, Dreyfus bought it as soon as it made a new high in price and traded between $50 and $51. The stocks had also formed certain chart price patterns before leaping into new high ground. This gave me 2 vitally important clues. Buying on new highs was important, and certain chart patterns spelled big profit potential. Jack Dreyfus was a chartist. Jack Dreyfus was a chartist and a tape reader. He bought all his stocks based on market action, and only when the price broke to new highs off sound chart patterns. He was also beating the pants off every competitor who ignored the real-world facts of market behavior, supply and demand, and depended only on fundamental, analytical personal opinions. Jack's research department in those early, big performance days consisted of 3 young Turks who posted the day's price and volume action of hundreds of listed stocks to very oversized charts. I saw these charts one day when I visited Dreyfus's headquarters in New York. Shortly thereafter, 2 small funds run by Fidelity in Boston started doing the same thing. They, too, produced superior results. One was managed by Ned Johnson, Jr., and the other by Jerry Tsai. Almost all the stocks that the Dreyfus and Fidelity funds bought also had strong increases in their quarterly earnings reports. So the first buy rules I made in 1960 were as follows. 1. Concentrate on listed stocks that sell for more than $20 a share with at least some institutional acceptance. 2. Insist that the companies show increases in earnings per share in each of the past 5 years, and that the current quarterly earnings are up at least 20%. 3. Buy when the stock is making or about to make a new high in price after emerging from a sound correction and price consolidation period. This breakout should be accompanied by a volume increase to at least 50% above the stock's average daily volume. First stock I bought under my new set of buy rules was Universal Match in February 1960. It doubled in 16 weeks, but I failed to make much money because I didn't have much money to invest. I was just getting started as a stockbroker, and I didn't have many customers. I also got nervous and sold it too quickly. Later that year, sticking with my well-defined game plan, I selected Procter & Gamble, Reynolds Tobacco, and MGM. They too made outstanding price moves, but I still didn't make much money because the money I had to invest was limited. About this time, I was accepted to Harvard Business School's first program for management development, PMD. In what little extra time I had at Harvard, I read a number of business and investment books in the library. Best was How to Trade in Stocks by Jesse Livermore. From this book, I learned that your objective in the market was not to be right, but to make big money when you were right. Jesse Livermore and pyramiding. After reading his book, I adopted Livermore's method of pyramiding or averaging up when a stock advanced after I purchased it. Averaging up is a technique where, after your initial stock purchase, you buy additional shares of the stock when it moves up in price. This is usually warranted when the first purchase of a stock is made precisely at a correct pivot, or buy point, and the price has increased 2% or 3% from the original purchase price. Essentially, I followed up what was working with additional but always smaller purchases, allowing me to concentrate my buying when I seemed to be right. If I was wrong and the stock dropped a certain amount below my cost, I sold the stock to cut short every loss. This is very different from how the majority of people invest. Most of them average down, meaning they buy additional shares as a stock declines in price in order to lower their cost per share. But why add more of your hard-earned money to stocks that aren't working? Learning by analysis of my failures. In the first half of 1961, my rules and plan worked great. Some of the top winners I bought that year were Great Western Financial, Brunswick, Kerr-McGee, Crown, Cork and Seal, AMF, and CertainTeed. But by summer, all was not well. I had bought the right stocks at exactly the right time, and I had pyramided with several additional buys, so I had good positions and profits. But when the stocks finally topped, I held on too long and watched my profits vanish. If you've been investing for a while, I'll bet you know exactly what I'm talking about. It's a problem you must tackle and solve if you want real results. When you snooze, you lose. It was hard to swallow. I'd been dead right on my stock selections for more than a year, but I had just broken even. I was so upset that I spent the last 6 months of 1961 carefully analyzing every transaction I had made during the prior year. Much like doctors do post-mortem operations and the Civil Aeronautics Board conducts post-crash investigations, I took a red pen and marked on charts exactly where each buy and sell decision was made. Then, I overlaid the general market averages. Eventually, my problem became crystal clear. I knew how to select the best leading stocks, but I had no plan for when to sell them and take profits. I had been completely clueless, a real dummy. I was so unaware that I had never even thought about when should a stock be sold and a profit taken. My stocks went up and then down like yo-yos, and my paper profits were wiped out. For example, the way I handled CertainTeed, a building materials company that made shell homes, was especially poor. I bought the stock in the low $20s, but during a weak moment in the market, I got scared and sold it for only a 2 or 3 point gain. CertainTeed went on to triple in price. I was in at the right time, but I didn't recognize what I had and failed to capitalize on a phenomenal opportunity. My analysis of CertainTeed and other such personal failures proved to be the critical key to my seeing what I had been doing wrong that I had to correct if I was to get on the right track to future success. Have you ever analyzed every one of your failures so you can learn from them? Few people do. What a tragic mistake you'll make if you don't look carefully at yourself and the decisions you've made in the stock market that did not work. You get better only when you learn what you've done wrong. This is the difference between winners and losers, whether in the market or in life. If you got hurt in the 2000 or 2008 bear market, don't get discouraged and quit. Plot out your mistakes on charts, study them, and write some additional new rules that, if you follow them, will correct your mistakes and let you avoid the actions that cost you a lot of time and money. You'll be that much closer to fully capitalizing on the next bull market. And in America, there will be many future bull markets. You're never a loser until you quit and give up or start blaming other people, like most politicians do. If you do what I've suggested here, it could just change your whole life. There are no secrets to success, said General Colin Powell, former Secretary of State. It is the result of preparation, hard work, and learning from failure. My revised profit and loss plan. As a result of my analysis, I discovered that successful stocks, after breaking out of a proper base, tend to move up 20% to 25%. Then they usually decline, build new bases, and in some cases resume their advances. With this new knowledge in mind, I made a rule that I'd buy each stock exactly at the pivot buy point and have the discipline not to pyramid or add to my position at more than 5% past that point. Then I'd sell each stock when it was up 20% while it was still advancing. In the case of Certain Teed, however, the stock ran up 20% in just 2 weeks. This was the type of super winner I was hoping to find and capitalize on the next time around. So, I made an absolutely important exception to the sell at plus 20% rule. If the stock was so powerful that it vaulted 20% in only 1, 2, or 3 weeks, it had to be held for at least 8 weeks. It would be analyzed to see if it should be held for a possible 6-month long-term capital gain. 6 months was the long-term capital gains period at that time. If a stock fell below its purchase price by 8%, I would sell it and take the loss. So, here was the revised profit and loss plan. Take 20% profits when you have them, except with the most powerful of all stocks, and cut your losses at a maximum of 8% below your purchase price. The plan had several big advantages. You could be wrong twice and right once and still not get into financial trouble. When you were right and you wanted to follow up with another, somewhat smaller buy in the same stock a few points higher, you were frequently forced into a decision to sell one of your more laggard or weakest performers. Money in your slower performing stock positions was continually force-fed into your best performers. Over a period of years, I came to almost always make my first follow-up purchase automatically as soon as my initial buy was up 2% or 2% in price. This lessened the chance that I might hesitate and wind up making the additional buy when the stock was up 5% to 10%. When you appear to be right, you should always follow up. When a boxer in the ring finally has an opening and lands a powerful punch, he must always follow up his advantage if he wants to win. By selling your laggards and putting the proceeds into your winners, you are putting your money to far more efficient use. You could make 2 or 3 20% plays in a good year, and you wouldn't have to sit through so many long, unproductive corrections while a stock built a whole new base. 20% gain in 3 to 6 months is substantially more productive than a 20% gain that takes 12 months to achieve. 2 20% gains compounded in 1 year equals a 44% annual rate of return. When you're more experienced, you can use full margin, buying power in a margin account, and increase your compounded return to nearly 100%. How I discovered the general market system. Another exceedingly profitable observation I made from analyzing every one of my money losing, out of ignorance mistakes, was that most of my market-leading stocks that topped had done so because the general market started into a decline of 10% or more. This conclusion finally led to my discovering and developing our system of interpreting the daily general market, averages, price, and volume chart. Gave us the critical ability to establish the true trend and major changes of direction in the overall market. 3 months later, by April 1, 1962, following all of my selling rules had automatically forced me out of every stock. I was 100% in cash, with no idea the market was headed for a real crash that spring. This is the fascinating thing. The rules will force you out, but you don't know how bad it can really get. You just know it's going down and you're out, which sooner or later will be worth its weight in gold to you. That's what happened in 2008. Our rules forced us out, and we had no idea the market was headed for a major breakdown. Most institutional investors were affected because their investment policy was to be fully invested 95% to 100%. In early 1962, I had finished reading Reminiscences of a Stock Operator by Edwin Lefevre. I was struck by the parallels between the stock market panic of 1907, which Lefevre discussed in detail, and what seemed to be happening in April 1962. Since I was 100% in cash, and my daily Dow analysis said the market was weak at that point, I began to sell short stocks such as certain Teed and Alcide, and earlier sympathy played a certain Teed. For this, I got into trouble with Hayden, Stone's home office on Wall Street. The firm had just recommended certain Teed as a buy, and here I was going around telling everyone it was a short sale. Later in the year, I sold Corvette short at over $40. The profits from both of these short sales were good. By October 1962, during the Cuban Missile Crisis, I was again in cash. Day or two after the Soviet Union backed down from President Kennedy's wise naval blockade, a rally attempt in the Dow Jones Industrial Average followed through, signaling a major upturn according to my new system. I then bought the first stock of the new bull market, Chrysler, at 58.58. It had a classic cup with handle base. Throughout 1963, I simply followed my rules to the letter. It worked so well that the worst performing account I managed that year was up 115%. It was a cash account. Other accounts that used margin were up several 100%. There were many individual stock losses, but they were usually small, averaging 5% to 6%. Profits, on the other hand, were awesome because of the concentrated positions we built by careful, disciplined pyramiding when we were right. Starting with only $4,000 or $5,000 that I had saved from my salary, plus some borrowed money and the use of full margin, I had 3 back-to-back big winners: Corvette on the short side in late 1962, Chrysler on the buy side, and Syntex, which was bought at $100 per share with the Chrysler profit in June 1963. After 8 weeks, Syntex was up 40%, and I decided to play this powerful stock out for 6 months. By the fall of 1963, the profit had topped $200,000, and I decided to buy a seat on the New York Stock Exchange. So don't ever let anyone tell you it can't be done. You can learn to invest wisely as long as you're willing to study all of your mistakes, learn from them, and write new self-correcting rules. This can be the greatest opportunity of a lifetime if you are determined, not easily discouraged, and willing to work hard and prepare yourself. Anyone can make it happen. For me, many long evenings of study led to precise rules, disciplines, and a plan that finally worked. Luck had nothing to do with it. It was persistence and hard work. You can't expect to watch television, drink beer, or party with your friends every night and still find the answers to something as complicated as the stock market or the U.S. economy. In America, anyone can do anything by working at it. There are no limits placed on you. It all depends on your desire and your attitude. It makes no difference where you're from, what you look like, or where you went to school. You can improve your life and your future and capture the American dream, and you don't have to have a lot of money to start. If you get discouraged at times, don't ever give up. Go back and put in some detailed extra effort. It's always the study and learning time that you put in after 9 to 5, Monday through Friday, that ultimately makes the difference between winning and reaching your goals, and missing out on truly great opportunities that really can change your whole life. 2 things to remember about selling. Before we examine the key selling rules one by one, keep these 2 key points in mind. First, buying precisely right solves most of your selling problems. If you buy at exactly the right time off a proper daily or weekly chart base in the first place, and you do not chase or pyramid a stock when it's extended in price more than 5% past a correct pivot buy point, you will be in a position to sit through most normal corrections. Winning stocks very rarely drop 8% below a correct pivot buy point. In fact, most big winners don't close below their pivot point. Buying as close to the pivot point as possible is therefore absolutely essential and may let you cut the smaller number of resulting losses more quickly than 8%. A stock might have to drop only 4% or 5% before you know something could be wrong. Second, beware of the big block selling you might see on a ticker tape or your PC just after you buy a stock during a bull market. The selling might be emotional, uninformed, temporary, or not as large relative to past volume as it appears. The best stocks can have sharp sell-offs for a few days or a week. Consult a weekly basis stock chart for an overall perspective to avoid getting scared or shaken out in what may just be a normal pullback. In fact, 40% to 60% of the time, a winning stock may pull back to its exact buy point or slightly below and try to shake you out. But it should not be down 8% unless you chased it too high in price when you bought it. If you're making too many mistakes and nothing seems to be working for you, check and make sure you're not making a number of your buys 10%, 15%, or 20% above the precise, correct buy point. Chasing stocks rarely works. You can't buy when you get more excited. Technical sell signs. By studying how the greatest stock market winners, as well as the market itself, all topped, I came up with the following list of factors that occur when a stock tops and rolls over. Perhaps you've noticed that few of the selling rules involve changes in the fundamentals of a stock. Many big investors get out of a stock before trouble appears on the income statement. If the smart money is selling, so should you. Individual investors don't stand much chance when institutions begin liquidating large positions. You buy with heavy emphasis on the fundamentals, such as earnings, sales, profit margins, return on equity, and new products. But many stocks peak when earnings are up 100% and analysts are projecting continued growth and higher price targets. On the same day in 1999 that I sold Charles Schwab stock on a climax top run-up and an exhaustion gap, one of the largest brokerage firms in America projected that the stock would go up 50 points more. Virtually all of my successful stocks were sold on the way up while they were advancing and the market was not affected. A bird in the hand is worth two imaginary ones in the bush. Therefore, you must frequently sell based on unusual market action, price, and volume movement, not personal opinions from Wall Street. You must wean yourself from listening to personal opinions. Since I never worked on Wall Street, I never got distracted by these diversions. There are many signals to look for when you're trying to recognize when a stock could be in a topping process. These include the price movements surrounding climax tops, adverse volume, and other weak action. A lot of this will become clearer to you as you continue to study this information and apply it to your daily decision-making. These rules and principles have been responsible for most of my better decisions in the market, but they can seem a bit complicated at first. I suggest that you reread Chapter 2 on chart reading, then read these selling rules again. In fact, most of the IBD subscribers I've met at our hundreds of workshops who have enjoyed real success with their investments have told me that they read this entire book 2 or 3 times, or even more. You probably aren't going to get it all in one reading. Some who have been distracted by all the outside noise say that they read it periodically to help them get back on the right track. Climax tops. Many leading stocks top in an explosive fashion. They make climax runs, suddenly advancing at a much faster rate for 1 or 2 weeks after an advance of many months. In addition, they often end in exhaustion gaps when a stock's price opens up on a gap from the prior day's close, on heavy volume. These and related bull market climax signals are discussed in detail here. 1. Largest daily price run-up. If a stock's price is extended, that is, if it's had a significant run-up for many months from its buy point off a sound and proper base, and it closes for the day with a larger price increase than on any previous up day since the beginning of the whole move up, watch out. This usually occurs very close to a stock's peak. 2. Heaviest daily volume. The ultimate top might occur on the heaviest volume day since the beginning of the advance. 3. Exhaustion gap. If a stock that's been advancing rapidly is greatly extended from its original base many months ago, usually at least 18 weeks out of a first or second stage base, and 12 weeks or more if it's out of a later stage base, and then opens on a gap up in price from the previous day's close, the advance is near its peak. For example, a 2-point gap in a stock's price after a long run-up would occur if it closed at its high of $50 for the day, then opened the next morning at $52 and held above $52 during the day. This is called an exhaustion gap. 4. Climax top activity. Sell if a stock's advance gets so active that it has a rapid price run-up for 2 or 3 weeks on a weekly chart, or for 7 of 8 days in a row or 8 of 10 days on a daily chart. This is called a climax top. The price spread from the stock's low to its high for the week will almost always be greater than that for any prior week since the beginning of the original move many months ago. In a few cases, around the top of a climax run, a stock may retrace the prior week's large price spread from the prior week's low to its high point and close the week up a little, with volume remaining very high. I call this railroad tracks because on a weekly chart, you'll see 2 parallel vertical lines. This is a sign of continued heavy volume distribution without real additional price progress for the week. 5. Signs of distribution. After a long advance, heavy daily volume without further upside price progress signals distribution. Sell your stock before unsuspecting buyers are overwhelmed. Also know when savvy investors are due to have a long-term capital gain. 6. Stock splits. Sell if a stock runs up 25% to 50% for 1 or 2 weeks on a stock split. In a few rare cases, such as Qualcomm at the end of 1999, it could be 100%. Stocks tend to top around excessive stock splits. If a stock's price is extended from its base and a stock split is announced, in many cases the stock could be sold. 7. Increase in consecutive down days. For most stocks, the number of consecutive down days in price relative to up days in price will probably increase when the stock starts down from its top. You may see 4 or 5 days down, followed by 2 or 3 days up, whereas before you would have seen 4 days up and then 2 or 3 down. 8. Upper channel line. You should sell if a stock goes through its upper channel line after a huge run-up. On a stock chart, channel lines are somewhat parallel lines drawn by connecting the lows of the price pattern with one straight line, and then connecting 3 high points made over the past 4 to 5 months with another straight line. Studies show that stocks that surge above their properly drawn upper channel lines should be sold. 9. 200-day moving average line. Some stocks may be sold when they are 70% to 100% or more above their 200-day moving average price line, although I have rarely used this one. 10. Selling on the way down from the top. If you didn't sell early while the stock was still advancing, sell on the way down from the peak. After the first breakdown, some stocks may pull back up in price once. Low volume and other weak action. 1. New highs on low volume. Some stocks will make new highs on lower or poor volume. As the stock goes higher, volume trends lower, suggesting that big investors have lost their appetite for the stock. 2. Closing at or near the day's price low. Tops can also be seen on a stock's daily chart in the form of arrows pointing down. That is, for several days, the stock will close at or near the low of the daily price range, fully retracing the day's advance. 3. Third or fourth stage bases. Sell when your stock makes a new high in price off a third or fourth stage base. The third time is seldom a charm in the market. By then, an advancing stock has become too obvious, and almost everyone sees it. These late-stage base patterns are often faulty, appearing wider and looser. As much as 80% of fourth stage bases should fail, but you have to be right in determining that this is a fourth stage base. 4. Signs of a poor rally. When you see initial heavy selling near the top, the next recovery will follow through weaker in volume, show poor price recovery, or last fewer days. Sell on the second or third day of a poor rally. It may be the last good chance to sell before trend lines and support areas are broken. 5. Decline from the peak. After a stock declines 8% or so from its peak, in some cases examination of the previous run-up, the top, and the decline may help you determine whether the advance is over or whether a normal 8% to 15% correction is in progress. You may occasionally want to sell if a decline from the peak exceeds 12% or 15%. 6. Poor relative strength. Poor relative price strength can be another reason for selling. Consider selling when a stock's IB's relative price strength rating drops below 70. 7. Lone Ranger. Consider selling if there is no confirming price strength by any other important member of the same industry group. Breaking support. Breaking support occurs when stocks close for the week below established major trend lines. 1. Long-term uptrend line is broken. Sell if a stock closes at the end of the week below a major long-term uptrend line or breaks a key price support area on overwhelming volume. An uptrend line should connect at least 3 intraday or intraweek price lows occurring over a number of months. Trend lines drawn over too short a time period aren't valid. 2. Greatest one-day price drop. If a stock has already made an extended advance and suddenly makes its greatest one-day price drop since the beginning of the move, consider selling if the move is confirmed by other signals. 3. Falling price on heavy weekly volume. In some cases, sell if a stock breaks down on the largest weekly volume in its prior several years. 4. 200-day moving average line turns down. After a prolonged upswing, if a stock's 200-day moving average price line turns down, consider selling the stock. Also, sell on new highs if a stock has a weak base with much of the price work in the lower half of the base or below the 200-day moving average price line. 5. Living below the 10-week moving average. Consider selling if a stock has a long advance, then closes below its 10-week moving average and lives below that average for 8 or 9 consecutive weeks, unable to rally and close the week above the line. Other prime selling pointers. 1. If you cut all your losses at 7% or 8%, take a few profits when you're up 20%, 25%, or 30%. Compounding 3 gains like this could give you an overall gain of 100% or more. However, don't sell and take a 25% or 30% gain in any market leader with institutional support that's run up 20% in only 1, 2, or 3 weeks from the pivot buy point on a proper base. Those could be your big leaders and should be held for a potentially greater profit. 2. If you're in a bear market, get off margin, raise more cash, and don't buy very many stocks. If you do buy, maybe you should take 15% profits and cut all your losses at 3%. 3. In order to sell, big investors must have buyers to absorb their stock. Therefore, consider selling if a stock runs up and then good news or major publicity, a cover article in Business Week, for example, is released. 4. Sell when there's a great deal of excitement about a stock and it's obvious to everyone that the stock is going higher. By then, it's too late. Jack Dreyfus said, "Sell when there is an overabundance of optimism." When everyone is bubbling over with optimism and running around trying to get everyone else to buy, they are fully invested. At this point, all they can do is talk. They can't push the market up anymore. It takes buying power to do that. Buy when you're scared to death and others are unsure. Wait until you're happy and tickled to death to sell. 5. In most cases, sell when the percentage increases in quarterly earnings slow materially, or by 2/3 from the prior rate of increase for 2 consecutive quarters. 6. Be careful of selling on bad news or rumors. They may be of temporary influence. Rumors are sometimes started to scare individual investors, the little fish, out of their holdings. 7. Always learn from all your past selling mistakes. Your own post-analysis by plotting your past buy and sell points on charts. Study your mistakes carefully and write down additional rules to avoid past mistakes that caused excessive losses or big missed opportunities. That's how you become a savvy investor. And to be patient and hold a stock. Closely related to the decision on when to sell is when to sit tight. Here are some suggestions for doing just that. Buy growth stocks where you can project a potential price target based on earnings estimates for the next year or two and possible P/E expansion from the stock's original base breakout. Your objective is to buy the best stock with the best earnings at exactly the right time and to have the patience to hold it until you have been proven right or wrong. In a few cases, you may have to allow 13 weeks after your first purchase before you conclude that a stock that hasn't moved is a dull, faulty selection. This, of course, applies only if the stock did not reach your defensive, loss-cutting sell price first. In a fast-paced market, like the one in 1999, tech stocks that didn't move after several weeks while the general market was rallying could have been sold earlier, and the money moved into other stocks that were breaking out of sound bases with top fundamentals. When your hard-earned money is on the line, it's more important than ever to pay attention to the general market and check IBDs, the big picture column, which analyzes the market averages. Both the 2000 top and the top in the 2007-2008 market, the big picture column and our sell rules got many subscribers out of the market and helped them dodge devastating declines. If you make new purchases when the market averages are under distribution, topping, and starting to reverse direction, you'll have trouble holding the stocks you've bought. Most breakouts will fail, and most stocks will go down, so stay in phase with the general market. Don't argue with a declining market. After a new purchase, draw a defensive sell line in red on a daily or weekly graph at the precise price level at which you will sell and cut your loss, 8% or less below your buy point. In the first 1 to 2 years of a new bull market, you may want to give stocks this much room on the downside and hold them until the price touches the sell line before selling. In some instances, the sell line may be raised but kept below the low of the first normal correction after your initial purchase. If you raise your loss-cutting sell point, don't move it up too close to the current price. This will keep you from being shaken out during any normal weakness. You definitely shouldn't continue to follow a stock up by raising stop-loss orders because you will be forced out near the low of an inevitable, natural correction. Once your stock is 15% or more above your purchase price, you can begin to concentrate on the price where or under what rules you will sell it on the way up to nail down your profit. Any stock that rises close to 20% should never be allowed to drop back into the loss column. If you buy a stock at $50 and it shoots up to $60 plus 20% or more, even if you don't take the profit when you have it, there's no intelligent reason to ever let the stock drop all the way back to $50 or below and create a loss. You may feel embarrassed, ridiculous, and not too bright if you buy at $50, watch the stock hit $60, and then sell at $50 to $51. You've already made the mistake of not taking your profit. Now avoid making a second mistake by letting it develop into a loss. Remember, one important objective is to keep all your losses as small as possible. Also, major advances require time to complete. Don't take profits during the first 8 weeks of a move unless the stock gets into serious trouble or is having a 2 or 3 week climax run up on a stock split in a late stage base. Stocks that show a 20% profit in less than 8 weeks should be held through the 8 weeks, unless they are of poor quality without institutional sponsorship or strong group action. In many cases, stocks that advance dramatically by 20% or more in only 1 to 4 weeks are the most powerful stocks of all, capable of doubling, tripling, or more. If you own one of these true can slim market leaders, try to hold it through the first couple of times it pulls back in price to, or slightly below, its 10-week moving average price line. Once you have a decent profit, you could also try to hold the stock through its first short-term correction of 10% to 20%. When a stock breaks out of a proper base, after its first move up, 80% of the time it will pull back somewhere between its second and its 6th week out of the base. Holding for 8 weeks, of course, gets you through this first selling squall and into a resumed uptrend, and you'll then have a better profit cushion. Remember, your objective is not just to be right, but to make big money when you are right. It never is your thinking that makes big money, said Livermore. It's the sitting. Investors who can be right and sit tight are rare. It takes time for a stock to make a large gain. The first 2 years of a new bull market typically provide your best and safest period, but they require courage, patience, and profitable sitting. If you really know and understand a company thoroughly and its products well, you'll have the crucial additional confidence required to sit tight through several inevitable but normal corrections. Achieving giant profits in a stock takes time and patience and following rules. You've just read one of the most valuable chapters in this book. If you review it several times and adopt a disciplined profit and loss plan for your own investments, it could be worth several thousand times what you paid for this book. You might even make a point of rereading this chapter once every year. You can't become a big winner in the market until you learn to be a good seller as well as a good buyer. Readers who followed these historically proven sell rules during 2000 nailed down most of the substantial gains they had made in 1998 and 1999. A few serious students made 500% to 1,000% or more during that fast-moving period. Again, in 2008, an even greater percentage of IBD readers, although not everyone, after much work and study, were able to implement proper selling rules to protect and preserve their hard-earned capital rather than succumb to the dramatic declines in the year's third and fourth quarters. Chapter 12, Money Management. Should you diversify, invest for the long haul, use margin, sell short, or buy options, IPO, tax shelters, Nasdaq stocks, foreign stocks, bonds, or other assets? Once you have decided to participate in the stock market, you are faced with more decisions than just which stock to purchase. You have to decide how you will handle your portfolio, how many stocks you should buy, what types of actions you will take, and what types of investments are better left alone. This and the following chapter will introduce you to the many options and alluring diversions you have at your disposal. Some of them are beneficial and worthy of your attention, but many others are overly risky, extremely complicated, or unnecessarily distracting and less rewarding. Regardless, it helps to be informed and to know as much about the investing business as possible, if for no other reason than to know all the things you should avoid. I say don't make it too complicated, keep it simple. How many stocks should you really own? How many times have you been told, don't put all your eggs in one basket? On the surface, this sounds like good advice, but my experience is that few people do more than one or two things exceedingly well. Those who are jacks of all trades and masters of none are rarely dramatically successful in any field, including investing. Did all the esoteric derivatives help or harm Wall Street pros? Did experimenting with highly abnormal leverage of 50 or 100 to 1 help or hurt them? Would you go to a dentist who did a little engineering or cabinet making on the side and who on weekends wrote music and worked as an auto mechanic, plumber, and accountant? This is true of companies as well as people. Best example of diversification in the corporate world is the conglomerate. Most large conglomerates do not do well. They're too big, too inefficient, and too spread out over too many businesses to focus effectively and grow profitably. Whatever happened to Jimmy Ling and Ling Temco, Vought, or to Gulf plus Western Industries after the conglomerate craze of the late 1960s collapsed? Big business and big government in America can both become inefficient, make many mistakes, and create nearly as many big new problems as they hope to solve. Do you remember when Mobil Oil diversified into the retail business by acquiring Montgomery Ward, the struggling national department store chain, years ago? It never worked. Neither did Sears. Roebuck's move into financial services with the purchases of Dean Witter and Coldwell Banker, or General Motors' takeover of computer services, giant EDS, or hundreds of other corporate diversification attempts. How many different businesses and types of loans was New York Citigroup involved in from 2000 to 2008? The more you diversify, the less you know about any one area. Many investors over-diversify. Best results are usually achieved through concentration, by putting your eggs in a few baskets that you know well and watching them very carefully. Did broad diversification protect your portfolio in the 2000 break or in 2008? The more stocks you own, the slower you may be to react and take selling action to raise sufficient cash when a serious bear market begins, because of a false sense of security. When major market tops occur, you should sell, get off margin if you use borrowed money, and raise at least some cash. Otherwise, you'll give back most of your gains. The winning investor's objective should be to have one or two big winners rather than dozens of very small profits. It's much better to have a number of small losses and a few very big profits. Broad diversification is plainly and simply often a hedge for ignorance. Did all the banks from 1997 to 2007 that bought packages containing 5,000 widely diversified different real estate loans that had the implied backing of the government and were labeled triple a protect and grow their investments? Most people with $20,000 to $200,000 to invest should consider limiting themselves to 4 or 5 carefully chosen stocks they know and understand. Once you own 5 stocks and a tempting situation comes along that you want to buy, you should muster the discipline to sell your least attractive investment. If you have $5,000 to $20,000 to invest, 3 stocks might be a reasonable maximum. A $3,000 account could be confined to 2 equities. Keep things manageable. The more stocks you own, the harder it is to keep track of all of them. Even investors with portfolios of more than $1 million need not own more than 6 or 7 well-selected securities. If you're uncomfortable and nervous with only 6 or 7, then own 10. But owning 30 or 40 could be a problem. The big money is made by concentration, provided you use sound buy and sell rules along with realistic general market rules. And there certainly is no rule that says that a 50-stock portfolio can't go down 50% or more. How to spread your purchases over time. It's possible to spread out your purchases over a period of time. This is an interesting form of diversifying. When I accumulated a position in Amgen in 1990 and 1991, I bought on numerous days. I spread out the buying and made add-on buys only when there was a significant gain on earlier buys. If the market price was 20 points over my average cost and a new buy point occurred off a proper base, I bought more, but I made sure not to run my average cost up by buying more than a limited or moderate edition. However, newcomers should be extremely careful in trying this more risky, highly concentrated approach. You have to learn how to do it right, and you positively have to sell or cut back if things don't work as expected. In a bull market, one way to maneuver your portfolio toward more concentrated positions is to follow up your initial buy and make 1 or 2 smaller additional buys in stocks as soon as they have advanced 2% to 3% above your initial buy. However, don't allow yourself to keep chasing a stock once it's extended too far past a correct buy point. This will also spare you the frustration of owning a stock that goes a lot higher but isn't doing your portfolio much good because you own fewer shares of it than you do of your other, less successful issues. At the same time, sell and eliminate stocks that start to show losses before they become big losses. Using this follow-up purchasing procedure should keep more of your money in just a few of your best stock investments. No system is perfect, but this one is more realistic than a haphazardly diversified portfolio and has a better chance of achieving important results. Diversification is definitely sound, just don't overdo it. Always set a limit on how many stocks you will own and stick to your rules. Always keep your set of rules with you in a simple notebook, perhaps, when you're investing. What? You say you've been investing without any specific buy or sell rules. What results has that produced for you over the last 5 or 10 years? Should you invest for the long haul? If you do decide to concentrate, should you invest for the long haul or trade more frequently? The answer is that the holding period, long or short, is not the main issue. What's critical is buying the right stock, the very best stock, at precisely the right time, then selling it whenever the market or your various sell rules tell you it's time to sell. The time between your buy and your sell could be either short or long. Let your rules and the market decide which one it is. If you do this, some of your winners will be held for 3 months, some for 6 months, and a few for 1, 2, or 3 years or more. Most of your losers will be held for much shorter periods, normally between a few weeks and 3 months. No well-run portfolio should ever have losses carried for 6 months or more. Keep your portfolio clean and in sync with the market. Remember, good gardeners always weed the flower patch and prune weak stems. Lessons for buy and hold investors who don't use charts. I've marked up the weekly charts of WorldCom in 1999, Enron in 2001, and Citigroup, AIG, and General Motors in 2007. They show 10 to 15 specific signs that these investments should clearly have been sold at that time. Why you must always use charts. See what happens next. Actually, if you looked at a longer time period, there were even more sell signals. For example, Citigroup had dramatically underperformed on a relative strength basis for the prior 3 years, from 2004 through 2006, and its earnings growth during that time slowed from its growth rate throughout the 1990s. It pays to monitor your investment's price and volume activity. That's how you stop losing and start winning. Should you day trade? One type of investing that I have always discouraged people from doing is day trading, where you buy and sell stocks on the same day. Most investors lose money doing this. The reason is simple. You are dealing predominantly with minor daily fluctuations that are harder to read than basic trends over a longer time period. Besides, there's generally not enough profit potential in day trading to offset the commissions you generate and the losses that will inevitably occur. Don't try to make money so fast. Rome wasn't built in a day. There is a new form of day trading that is more like short-term swing trading, buying a stock on the upswing and selling before an inevitable pullback. It involves buying a stock at its exact pivot by point off a chart, coming out of a base or price consolidation area, and selling it 5 or so days later after the breakout. Sometimes pivot points off patterns such as the cup with handle pattern, see Chapter 2, identified on intraday charts of 5-minute intervals, can reveal a stock that is breaking out from an intraday pattern. If this is done with real skill in a positive market, it might work for some people, but it requires lots of time, study, and experience. Should you use margin? In the first year or two, while you're still learning to invest, it's much safer to invest on a cash basis. It usually takes most new investors at least 2 to 3 years before they gain enough market experience by making several bad decisions, wasting time trying to reinvent the wheel, and experimenting with unsound beliefs to be able to make and keep significant profits. Once you have a few years' experience, a sound plan, and a strict set of both buy and sell rules, you might consider buying on margin, using borrowed money from your brokerage firm in order to purchase more stock. Generally, margin buying should be done by younger investors who are still working. Their risk is somewhat less because they have more time to prepare for retirement. The best time to use margin is generally during the first 2 years of a new bull market. Once you recognize a new bear market, you should get off margin immediately and raise as much cash as possible. You must understand that when the general market declines and your stocks start sinking, you will lose your initial capital twice as fast if you're fully margined than you would if you were invested on a cash basis. This dictates that you absolutely must cut all losses quickly and get off margin when a major general market deterioration begins. If you speculate in small capitalization or high-tech stocks fully margined, a 50% correction can cause a total loss. This happened to some new investors in 2000 and early 2001. You don't have to be fully margined all the time. Sometimes you'll have large cash reserves and no margin. At other times, you'll be invested on a cash basis. At still other points, you'll be using a small part of your margin buying power. In a few instances, when you're making genuine progress in a bull market, you may be fully invested on margin. All of this depends on the current market situation and your level of experience. I've always used margin, and I believe it offers a real advantage to an experienced investor who knows how to confine his buying to high-quality market leaders and has the discipline and common sense to always cut his losses short with no exceptions. Your margin interest expense, depending on laws that change constantly, might be tax deductible. However, in certain periods, margin interest rates can become so high that the probability of substantial success may be limited. To buy on margin, you'll also need to sign a margin agreement with your broker. Never answer a margin call. If a stock in your margin account collapses in value to the point where your stockbroker asks you to either put up money or sell stock, don't put up money. Think about selling stock. 9 times out of 10, you'll be better off. The marketplace is telling you that you're on the wrong path, you're getting hurt, and things aren't working. So sell and cut back your risk level. Again, why throw good money after bad? What will you do if you put up good money and the stock continues to decline and you get more margin calls? Go broke backing a loser. Should you sell short? I did some research and wrote a booklet on short selling in 1976. It's now out of print, but not much has changed on the subject since then. In 2005, the booklet was the basis for a book titled How to Make Money Selling Short. The book was written with Gil Morales, who rewrote, revised, and updated my earlier work. Short selling is still a topic few investors understand, and an endeavor at which even fewer succeed, so consider carefully whether it's right for you. More active and seasoned investors might consider limited short selling, but I would want to keep the limit to 10% or 15% of available money, and most people probably shouldn't do even that much. Furthermore, short selling is far more complicated than simply buying stocks, and most short sellers are run in and lose money. What is short selling? Think of it as reversing the normal buy and sell process. In short selling, you sell a stock instead of buying it, even though you don't own it and therefore must borrow it from your broker, in the hope that it will go down in price instead of up. If the stock falls in price as you expect, you can cover your short position by buying the stock in the open market at a lower price and pocket the difference as your profit. You would sell short if you think the market is going to drop substantially or a certain stock is ready to cave in. You sell the stock first, hoping to buy it back later at a lower price. Sounds easy, right? Wrong. Short selling rarely works out well. Usually the stock that you sell short, expecting a colossal price decrease, will do the unexpected and begin to creep up in price. When it goes up, you lose money. Effective short selling is usually done at the beginning of a new general market decline. This means you have to short based on the behavior of the daily market averages. This, in turn, requires the ability to 1. Interpret the daily Dow, S&P 500, or NASDAQ indexes, as discussed in Chapter 9, and 2. Select stocks that have had tremendous run-ups and have definitely topped out months earlier. In other words, your timing has to be flawless. You may be right, but if you're too early, you can be forced to cover at a loss. In selling short, you also have to minimize your risk by cutting your losses at 8%. Otherwise, the sky's the limit, as your stock could have an unlimited price increase. My first rule in short selling: don't sell short during a bull market. Why fight the overall tide? But sooner or later you may disregard the advice in this book, try it for yourself, and find out the same hard way, just as you learn that wet paint signs usually mean what they say. In general, you should save the short selling for bear markets. Your odds will be a little better. The second rule is, never sell short a stock with a small number of shares outstanding. It's too easy for market makers and professionals to run up a thinly capitalized stock on you. This is called a short squeeze, meaning you could find yourself with a loss and be forced to cover by buying the stock back at a higher price, and when you're in one, it doesn't feel very good. It's safer to short stocks that are trading an average daily volume of 5 to 10 million shares or more. The 2 best chart price patterns for selling short are shown on the 2 graphs on page 288. 1. The head and shoulders top. The right shoulder of the price pattern on the stock chart must be slightly lower than the left. The correct time to short is when the 3rd or 4th pullback up in price during the right shoulder is about over. Note the 4 upward pullbacks in the right shoulder of the Lucent Technologies head and shoulders top. One of these upward price pullbacks will reach slightly above the peak of a rally a few weeks back. This serves to run in the premature short sellers. Former big market leaders that have broken badly can have several upward price pullbacks of 20% to 40% from the stock's low point in the right shoulder. The stock's last run-up should cross over its moving average line. The right time to short is when the volume picks up as the stock reverses lower and breaks below its 10-week moving average line on volume, but hasn't yet broken to new low ground, at which point it is too late and then becomes too obvious and apparent to most traders. In some, but not all cases, either there will be a deceleration in quarterly earnings growth or earnings will have actually turned down. Stock's relative strength line should also be in a clear downtrend for at least 20 weeks up to 34 weeks. In fact, we found through research on model stocks over 50 years that almost all outstanding short selling patterns occurred 5 to 7 months after a formerly huge market leader has clearly topped. John Wooden, the great UCLA basketball coach, used to tell his players, "It's what you learn after you know it all that counts." Well, one know-it-all investor wrote and told us that we obviously didn't know what we were talking about, that no knowledgeable person would ever sell a stock short 7 months after it had topped. Few people understand this, and most short sellers lose money because of premature, faulty, or overly obvious timing. Lucent at point 4 was in its 8th month and fell 89%. Yahoo was in its 8th month after it had clearly topped, and it then fell 87%. Egos in the stock market are very dangerous because they lead you to think you know what you're doing. The smarter you are, the more losses ego can create. Humility and respect for the market are more valuable traits. 2. Third or fourth stage cup with handle or other patterns that have definitely failed after attempted breakouts. The stock should be picking up trading volume and starting to break down below the handle area. See Chapter 2 on chart reading and failed breakouts. For years, short selling had to be executed on an uptick from the previous trade. An uptick is any trade that is higher than the previous trade by at least a penny. It used to be or a quarter point or more up. Therefore, orders should normally be entered either at the market or at a maximum, with a limit of $0.25 or so below the last price. A weak stock could trade down a point or more without having an uptick. After a careful study, the SEC recently rescinded the uptick rule. It should and probably will be reinstated at some point, with more than a penny price increase being required, perhaps a 10 or 20 cent rally. This should reduce volatility in some equities, especially in bad, panicky markets. The uptick rule was originally created in early 1937 after the market had broken seriously in the prior year. Its purpose was to require over a quarter of 1 point uptick, which would be 12.5 or 25 cents, to slow down the uninterrupted hammering that a stock would be subject to during severe market breaks. One alternative to selling short is buying put options, which don't need an uptick to receive an executed trade. You could also short tracking indexes like the QQQs, NASDAQ 100, SMHs, semiconductors, or BBHs, biotech. These also do not require an uptick. Shorting must be done in a margin account, so check with your broker to see if you can borrow the stock you want to sell short. Also, if the stock pays a dividend while you are short, you'll have to pay the dividend to the person who owned the stock you borrowed and sold. Lesson: don't short big dividend-paying stocks. Short selling is treacherous even for professionals, and only the more able and daring should give it a try. And last warning, don't short an advancing stock just because its price or the P/E ratio seems too high. You could be taken to the cleaners. What are options, and should you invest in them? Options are an investment vehicle where you purchase rights contracts to buy, call, or sell, put, a stock index, or commodity at a specified price before a specified future time, known as the option expiration date. Options are very speculative and involve substantially greater risks and price volatility than common stocks. Therefore, most investors should not buy or sell options. Winning investors should first learn how to minimize the investment risks they take, not increase them. After a person has proved that she is able to make money in common stocks and has sufficient investment understanding and actual experience, then the limited use of options could be intelligently considered. Options are like making all or nothing bets. If you buy a 3-month call option on McDonald's, the premium you pay gives you the right to purchase 100 shares of MCD at a certain price at any time during the next 3 months. When you purchase calls, you expect the price of the stock to go up. So if a stock is currently trading at $120, you might buy a call at $125. If the stock rises to $150 after 3 months, and you have not sold your call option, you can exercise it and pocket the $25 profit less the premium you paid. Conversely, if 3 months go by and your stock is down and didn't perform as expected, you would not exercise the option. It expires worthless, and you lose the premium you paid. As you might expect, puts are handled in a similar manner, except that you're making a bet that the price of the stock will decrease instead of increase. Limiting your risk when it comes to options. If you do consider options, you should definitely limit the percentage of your total portfolio committed to them. A prudent limit might be no more than 10% to 15%. You should also adopt a rule about where you intend to cut and limit all of your losses. The percentage will naturally have to be more than 8%, since options are much more volatile than stocks. If an option fluctuates 3 times as rapidly as the underlying stock, then perhaps 20% or 25% might be a possible absolute limit. On the profit side, you might consider adopting a rule that you'll take many of your gains when they hit 50% to 75%. Some aspects of options present challenges. Buying options whose price can be significantly influenced by supply and demand changes as a result of a thin or illiquid market for that particular option is problematic. Also problematic is the fact that options can be artificially and temporarily overpriced simply because of a short-lived increase in price volatility in the underlying stock or the general market. Buy only the best. When I buy options, which is rarely, I prefer to buy them for the most aggressive and outstanding stocks with the biggest earnings estimates, those where the premium you have to pay for the option is higher. Once again, you want options on the best stocks, not the cheapest. The secret to making money in options doesn't have much to do with options. You have to analyze and be right on the selection and timing of the underlying stock. Therefore, you should apply your ConSlim system and select the best possible stock at the best possible time. If you do this and you are right, the option will go up along with the stock, except that the option should move up much faster because of the leverage. By buying only options on the best stocks, you also minimize slippage caused by illiquidity. Slippage is the difference between the price you wanted to pay and the price you actually paid at the time the order was executed. The more liquid the stock, the less slippage you should experience. With illiquid small capitalization stocks, the slippage can be more severe, and this ultimately could cost you money. Buying options on lower-priced, illiquid stocks is similar to the carnival game where you're trying to knock down all the milk bottles. The game may be rigged. Selling your options can be equally tricky in a thin, small capitalization stock. In a major bear market, you might consider buying put options on certain individual stocks or on a major stock index like the S&P, along with selling shares of common stock short. The inability of your broker to borrow a stock may make selling short more difficult than buying a put. It is generally not wise to buy puts during a bull market. Why be a fish trying to swim upstream? If you think a stock is going up and it's the right time to buy, then buy it, or purchase a long-term option and place your order at the market. If it's time to sell, sell at the market. Option markets are usually thinner and not as liquid as the markets for the underlying stock itself. Many amateur option traders constantly place price limits on their orders. Once they get into the habit of placing limits, they are forever changing their price restraints as prices edge away from their limits. It is difficult to maintain sound judgment and perspective when you are worrying about changing your limits. In the end, you'll get some executions after tremendous excess effort and frustration. You finally pick the big winner for the year, the one that will triple in price. You'll lose out because you placed your order with a quarter-point limit below the actual market price. You never make big money in the stock market by eighths and quarters. You could also lose your shirt if your security is in trouble and you fail to sell and get out because you put a price limit on your sell order. Your objective is to be right on the big moves, not on the minor fluctuations. Short-term options are more risky. If you buy options, you're better off with longer time periods, say 6 months or so. This will minimize the chance your option will run out of time before your stock has had a chance to perform. Now that I've told you this, what do you think most investors do? Of course, they buy shorter-term option, 30 to 90 days, because these options are cheaper and move faster in both directions, up and down. The problem with short-term options is that you could be right on your stock, but the general market may slip into an intermediate correction, with the result that all stocks are down at the end of the short time period. You will then lose on all your options because of the general market. This is also why you should spread your option buying and option expiration dates over several different months. Keep option trading simple. One thing to keep in mind is that you should always keep your investments as simple as possible. Don't let someone talk you into speculating in such seemingly sophisticated packages as strips, straddles, and spreads. A strip is a form of conventional option that couples one call and two puts on the same security at the same exercise price with the same expiration date. The premium is less than it would be if the options were purchased separately. Straddle can be either long or short. A long straddle is a long call and a long put on the same underlying security at the same exercise price and with the same expiration month. A short straddle is a short call and a short put on the same security at the same exercise price and with the same expiration month. A spread is a purchase and sale of options with the same expiration dates. It's difficult enough to just pick a stock or an option that is going up. If you confuse the issue and start hedging being both long and short at the same time, you could, believe it or not, wind up losing on both sides. For instance, if a stock goes up, you might be tempted to sell your put early to minimize the loss, and later find that the stock has turned downward and you're losing money on your call. The reverse could also happen. It's a dangerous psychological game that you should avoid. Should you write options? Writing options is a completely different story from buying options. I am not overly impressed with the strategy of writing options on stocks. A person who writes a call option receives a small fee or premium in return for giving someone else, the buyer, the right to call away and buy the stock from the writer at a specified price, up to a certain date. In a bull market, I would rather be a buyer of calls than a writer-seller of calls. In bad markets, just stay out or go short. The writer of calls pockets a small fee and is, in effect, usually locked in for the time period of the call. But if the stock you own and wrote the call against gets into trouble and plummets, the small fee won't cover your loss. Of course, there are maneuvers the writer can take, such as buying a put to hedge and cover himself, but then situation gets too complicated and the writer could get whipsawed back and forth. What happens if the stock doubles? The writer gets the stock called away, and for a relatively small fee loses all chance for a major profit. I take risks in stocks for only meager gains with no chance for large gains. This is not the reasoning you will hear from most people, but then again, what most people are saying and doing in the stock market isn't usually worth knowing. Writing naked calls is even more foolish, in my opinion. Naked call writers receive a fee for writing a call on a stock they do not own, so they are unprotected if the stock moves against them. It's possible that large investors who have trouble making decent returns on their portfolio may find some minor added value in writing short-term options on stocks that they own and feel are overpriced. However, I am always somewhat skeptical of new methods of making money that seem so easy. There are few free lunches in the stock market or in real estate, great opportunities in Nasdaq stocks. Nasdaq stocks are not traded on a listed stock exchange, but instead are traded through over-the-counter dealers. The over-the-counter dealer market has been enhanced in recent years by a wide range of ECNs, electronic communication networks, such as Instanet, SelectNet, ReadyBook, and Archipelago, which bring buyers and sellers together within each network, and through which orders can be routed and executed. Nasdaq is a specialized field, and in many cases the stocks traded are those of newer, less established companies. But now even NYSE firms have large Nasdaq operations. In addition, reforms during the 1990s have removed any lingering stigma that once dogged the Nasdaq. There are usually hundreds of intriguing new growth stocks on the Nasdaq. It's also the home of some of the biggest companies in the United States. You should definitely consider buying better quality Nasdaq stocks that have institutional sponsorship and fit the CAN-SLIM rules. For maximum flexibility and safety, it's vital that you maintain marketability in all your investments, regardless of whether they're traded on the NYSE or on the Nasdaq. Institutional quality common stock with larger average daily volume is one defense against an unruly market. Should you buy initial public offerings, IPOs? An initial public offering is a company's first offering of stock to the public. I usually don't recommend that investors purchase IPOs. There are several reasons for this. Among the numerous IPOs that occur each year, there are a few outstanding ones. However, those that are outstanding are going to be in such hot demand by institutions who get first crack at them, that if you are able to buy them at all, you may receive only a tiny allotment. Logic dictates that if you, as an individual investor, can acquire all the shares you want, they are possibly not worth having. The internet and some discount brokerages have made IPOs more accessible to individual investors, although some brokers place limits on your ability to sell soon after a company comes public. This is a dangerous position to be in, since you may not be able to get out when you want to. You may recall that during the IPO craze of 1999 and early 2000, there were some new stocks that rocketed on their first day or two of trading, only to collapse and never recover. Many IPOs are deliberately underpriced and therefore shoot up on the first day of trading, but more than a few could be overpriced and drop. Because IPOs have no trading history, you can't be sure whether they're overpriced. In most cases, this speculative area should be left to experienced institutional investors who have access to the necessary in-depth research and who are able to spread their new issue risks among many different equities. This is not to say that you can't purchase a new issue after the IPO when the stock is up in its infancy. Google should have been bought in mid-September 2004, in the 5th week after its new issue, when it made a new high at 114. The safest time to buy an IPO is on the breakout from its first correction and base building area. Once a new issue has been trading in the market for 1, 2, or 3 months or more, you have valuable price and volume data that you can use to better judge the situation. Within the broad list of new issues of the previous 3 months to 3 years, there are always standout companies with superior new products and excellent current and recent quarterly earnings and sales that you should consider. Investors' Business Dailies, the New America page explores most of them. Past articles on a company may be available. CB Richard Ellis formed a perfect flat base after its IPO in the summer of 2004 and then rose 500%. Experienced investors who understand correct selection and timing techniques should definitely consider buying new issues that show good positive earnings and exceptional sales growth, and also have formed sound price bases. They can be a great source of new ideas if they are dealt with in this fashion. Most big stock winners in recent years had an IPO at some point in the prior 1 to 8 or 10 years. Even so, new issues can be more volatile and occasionally suffer massive corrections during difficult bear markets. This usually happens after a period of wild excess in the IPO market, where any and every offering seems to be a hot issue. For example, the new issue booms that developed in the early 1960s and the beginning of 1983, as well as that in late 1999 and early 2000, were almost always followed by a bear market period. Congress, at this writing in early 2009, should consider lowering the capital gains tax to create a powerful incentive for thousands of new entrepreneurs to start up innovative new companies. Our historical research proved that 80% of the stocks that had outstanding price performance and job creation in the 1980s and 1990s had been brought public in the prior 8 to 10 years, as mentioned earlier. America now badly needs a renewed flow of new companies to spark new inventions and new industries. And a stronger economy, millions more jobs, and millions more taxpayers. It has always paid for Washington to lower capital gains taxes. This will be needed to reignite the IPO market and the American economy after the economic collapse that the subprime real estate program and the credit crisis caused in 2008. I learned many years ago that if rates are raised, many investors will simply not sell their stock because they don't want to pay the tax and then have significantly less money to reinvest. Washington can't seem to understand this simple fact. Fewer people will sell their stocks, and the government will always get less revenue, not more. I've had many older, retired people tell me they will keep their stock until they die so they won't have to pay the tax. What are convertible bonds, and should you invest in them? A convertible bond is one that you can convert for another investment category, typically common stock, at a predetermined price. Convertible bonds provide a little higher income to the owner than the common stock typically does, along with the potential for some possible profits. Theory goes that a convertible bond will rise almost as fast as the common stock rises, but will decline less during downturns. As so often happens with theories, the reality can be different. There is also a liquidity question to consider, since convertible bond markets may dry up during extremely difficult periods. Sometimes investors are attracted to this medium because they can borrow heavily and leverage their commitment, obtain more buying power. This simply increases your risk. Excessive leverage can be dangerous, as Wall Street and Washington learned in 2008. It is for these several reasons that I do not recommend that most investors buy convertible bonds. I have also never bought a corporate bond. They are poor inflation hedges, and ironically, you can also lose a lot of money in the bond market if you make what ultimately turns out to be a higher risk investment in stretching for a higher yield. Should you invest in tax-free securities and tax shelters? The typical investor should not use these investment vehicles, IRA, 401k plans, and KIOGs accepted, the most common of which are municipal bonds. Over-concern about taxes can confuse and cloud investors' normally sound judgment. Common sense should also tell you that, if you invest in tax shelters, there is a much greater chance the IRS may decide to audit your tax return. Don't kid yourself. You can lose money in munis if you buy them at the wrong time or if the local or state government makes bad management decisions and gets into real financial trouble, which some of them have done in the past. People who seek too many tax benefits or tax dodges frequently end up investing in questionable or risky ventures. The investment decision should always be considered first, with tax considerations a distant second. This is America, where anyone who really works at it can become successful at saving and investing. Learn how to make a net profit, and when you do, be happy about it rather than complaining about having to pay taxes because you made a profit. Would you rather hold on until you have a loss so you have no tax to pay? Recognize at the start that Uncle Sam will always be your partner, and he will receive his normal share of your wages and investment gains. I have never bought a tax-free security or a tax shelter. This has left me free to concentrate on finding the best investments possible. When these investments work out, I pay my taxes just like everybody else. Always remember, the U.S. system of freedom and opportunity is the greatest in the world. Learn to use, protect, and appreciate it. Should you invest in income stocks? Income stocks are stocks that have high and regular dividend yields, providing taxable income to the owner. These stocks are typically found in supposedly more conservative industries, such as utilities and banks. Most people should not buy common stocks for their dividends or income, yet many people do. People think that income stocks are conservative and that you can just sit and hold them because you are getting your dividends. Talk to any investor who lost big on Continental Illinois Bank in 1984 when the stock plunged from $25 to $2, or on Bank of America when it crashed from $55 to $5 as of the beginning of 2009, or on the electric utilities caught up in the past with nuclear power plants. Ironically, 17 major nations now get or for years have gotten more of their electricity from nuclear power plants than the United States does. France gets 78% of its electricity from nuclear power. Investors also got hurt when electric utilities nosedived in 1994, and the same was true when certain California utilities collapsed in 2001. In theory, income stocks should be safer, but don't be lulled into believing that they can't decline sharply. 1999-2000, AT&T dropped from over $60 to below $20. And how about the aforementioned Citigroup, the New York City bank that so many institutional investors owned? I don't care how much it paid in dividends. If you owned Citigroup at $50 and watched it nosedive to $2 when it was in the process of going bankrupt until the government bailed it out, you lost an enormous amount of money. Incidentally, even if you do invest in income stocks, you should use charts. In October of 2007, Citigroup stock broke wide open on the largest volume month that it ever traded, so that even an amateur chartist could have recognized this and easily sold it in the $40s, avoiding a serious loss. If you do buy income stocks, never strain to buy the highest dividend yield available. It will typically entail much greater risk and lower quality. Trying to get an extra 2% or 3% yield can significantly expose your capital to larger losses. That's what a lot of Wall Street firms did in the real estate bubble, and look what happened to their investments. A company can also cut its dividends if its earnings per share are not adequately covering those payouts, leaving you without the income you expected to receive. This too has happened. If you need income, my advice is to concentrate on the very best quality stocks and simply withdraw 6% of your investments each year for living expenses. You could sell off a few shares and withdraw 1% per quarter. Higher rates of withdrawal are not usually advisable, since in time they might lead to some depletion of your principal. What are warrants, and are they safe investments? Warrants are an investment vehicle that allows you to purchase a specific amount of stock at a specific price. Sometimes warrants are good for a certain period of time, but it's common for them not to have time limits. Many of them are cheap in price and therefore seem appealing. However, most investors should shy away from low-priced warrants. This is another complex, specialized field that sounds fine in concept, but that few investors truly understand. The real question comes down to whether the common stock is correct to buy. Most investors will be better off if they forget the field of warrants. Should you invest in merger candidates? Merger candidates can often behave erratically, so I don't recommend investing in them. Some merger candidates run up substantially in price on rumors of a possible sale, only to have the price drop suddenly when a potential deal falls through or other unforeseen circumstances occur. In other words, this can be a risky, volatile business, and it should generally be left to experienced professionals who specialize in this field. It is usually better to buy sound companies, based on your basic and slim evaluation, than to try to guess whether a company will be sold or merged with another. Should you buy foreign stocks? A few foreign stocks have excellent potential if they are bought at the right time and the right place, but I don't suggest that people spend too much time getting substantially invested in them. The potential profit from a foreign stock should be a good bit more than that from a standout U.S. company to justify the potential additional risk. For example, investors in foreign securities must understand and closely follow the general market of the particular country involved. Sudden changes in that country's interest rates, currency, or government policy could, through one unexpected action, make your investment less attractive. It isn't necessary for you to search out a lot of foreign stocks when there are more than 10,000 securities to select from in the United States. Many worthy foreign stocks also trade in the United States, and a number had excellent success in the past, including Research in Motion, China Mobile, and America Movil. I owned 2 of them in the last bull market. All of these stocks benefited from the worldwide wireless boom, but corrected 60% or more in the bear market that followed this bull move. There are also some mutual funds that excel in foreign securities. As weak as our stock market was in 2008, many foreign markets declined even more. Baidu, a Chinese stock leader, dropped from $429 to $100. The Russian market plummeted straight down from 16,291 to 3237 once Putin invaded and intimidated the nation of Georgia. Avoid penny stocks and low-priced securities. The Canadian and Denver markets list many stocks that you can buy for only a few cents a share. I strongly advise that you avoid gambling in such cheap merchandise because everything sells for what it's worth. You get what you pay for. These seemingly cheap securities are unduly speculative and extremely low in quality. The risk is much higher with them than with better quality, higher-priced investments. The opportunity for questionable or unscrupulous promotional practices is also greater with penny stocks. I prefer not to buy any common stock that sells for below $15 per share, and so should you. Our extensive historical studies of 125 years of America's super winners show that most of them broke out of chart bases between $30 and $50 a share. What are futures, and should you invest in them? Futures involve buying or selling a specific amount of a commodity, financial issue, or stock index at a specific price on a specific future date. Most futures fall into the categories of grains, precious metals, industrial metals, foods, meats, oils, woods, and fibers, known collectively as commodities, financial issues, and stock indexes. The financial group includes government T-bills and bonds, plus foreign currencies. One of the more active stock indexes traded is the S&P 100, better known by its ticker symbol OEX. Large commercial concerns, such as Hershey, use the commodity market for hedging. For example, Hershey might lock in a current price by temporarily purchasing cocoa beans in May for December delivery, while arranging for a deal in the cash market. It is probably best for most individual investors not to participate in the futures markets. Commodity futures are extremely volatile and much more speculative than most common stocks. It is not an arena for the inexperienced or small investor unless you want to gamble or lose money quickly. However, once an investor has 4 or 5 years of experience, and has unquestionably proven her ability to make money in common stocks, if she is strong of heart, she might consider investing in futures on a limited basis. With futures, it is even more important that you be able to read and interpret charts. The chart price patterns in commodity prices are similar to those in individual stocks. Being aware of futures charts can also help stock investors evaluate changes in basic economic conditions in the country. There are a relatively small number of futures that you can trade. Therefore, astute speculators can concentrate their analysis. The rules and terminology of futures trading are different, and the risk is far greater, so investors should definitely limit the proportion of their investment funds that they commit to futures. There are worrisome events involved in futures trading, such as limit down days, where a trader is not allowed to sell and cut a loss. Risk management, i.e., position size and cutting losses quickly, is never more important than when trading futures. You should also never risk more than 5% of your capital in any one futures position. There is an outside chance of getting stuck in a position that has a series of limit up or limit down days. Futures can be treacherous and devastating. You could definitely lose it all. I have never bought commodity futures. I do not believe you can be a jack of all trades. Learn just one field as completely as possible. There are thousands of stocks to choose from. Should you buy gold, silver, or diamonds? As you might surmise, I do not normally recommend investing in metals or precious stones. Many of these investments have erratic histories. They were once promoted in an extremely aggressive fashion, with little protection afforded to the small investor. In addition, the dealer's profit markup on these investments may be excessive. Furthermore, these investments do not pay interest or dividends. There will always be periodic, significant run-ups in gold stocks caused by fears or panics brought about by potential problems in certain foreign countries. A few gold companies may also be in their own cycle, like Barrick Gold was in the late 1980s and early 1990s. This type of commodity-oriented trading can be an emotional and unstable game, so I suggest care and caution. Small investments in such equities, however, can be timely and reasonable at certain points. Should you invest in real estate? Yes, at the right time and in the right place. I am convinced that most people should work toward being able to own a home by building a savings account and investing in common stocks or a growth stock mutual fund. Home ownership has been a goal for most Americans. The ability over the years to obtain long-term, borrowed money with only a small or reasonable down payment has created the leverage necessary to eventually make real estate investments possible for most Americans. Real estate is a popular investment vehicle because it is fairly easy to understand and in certain areas can be highly profitable. About 2/3 of American families currently own their own homes. Time and leverage usually pay off. However, this is not always the case. People can and do lose money in real estate under many of the following realistic unfavorable conditions. 1. Make a poor initial selection by buying in an area that is slowly deteriorating or is not growing, or the area in which they've owned property for some time deteriorates. 2. They buy at inflated prices after several boom years and just before severe setbacks in the economy or in the particular geographic area in which they own real estate. This might occur if there are major industry layoffs or if an aircraft, auto, or steel plant that is an important mainstay of a local community closes. 3. They get themselves personally overextended with real estate payments and other debts that are beyond their means, or they get into inviting but unwise variable rate loans that could create difficult problems later, or they take out and live off of home equity borrowing rather than paying down their mortgage over time. 4. Their source of income is suddenly reduced by the loss of a job or by an increase in rental vacancies should they own rental property. 5. They are hit by fires, floods, tornadoes, earthquakes, or other acts of nature. People can also be hurt by well-meaning government policies and social programs that were not soundly thought through before being implemented, promoted, managed, operated, and overseen by the government. The subprime fiasco from 1995 to 2008 was caused by a good, well-intended government program that over time got completely out of control, with totally unexpected consequences that caused many of the very people the government hoped to help to lose their homes. It also caused huge job losses as business contracted. In the greater Los Angeles area alone, many minority owners in San Bernardino, Riverside, and Santa Ana were dramatically hurt by foreclosures. Basically, no one should ever buy a home unless he can come up with a down payment of at least 5%, 10%, or 20% on his own and has a relatively secure job. You need to earn and save toward your home buying goal, and avoid variable rate loans and smooth-talking salespeople who talk you into buying homes to flip, which exposes you to far more risk. And finally, don't take out home equity loans that can put your home in a greater risk position. Also, beware of getting into the terrible habit of using credit cards to run up big debts. That's a bad habit that will hurt you for years. You can make money and develop skill by learning about and concentrating on the correct buying and selling of high-quality growth-oriented equities rather than scattering your efforts among the myriad high-risk investment alternatives. As with all investments, do the necessary research before you make your decision. Remember, there's no such thing as a risk-free investment. Don't let anyone tell you there is. If something sounds too easy and good to be true, watch out. To summarize so far, diversification is good, but don't over-diversify. Concentrate on a smaller list of well-selected stocks and let the market help you determine how long each of them should be held. Using margin may be okay if you're experienced, but it involves significant extra risk. Don't sell short unless you know exactly what you're doing. Be sure to learn to use charts to help with your selection and timing. NASDAQ is a good market for newer entrepreneurial companies, but options and futures have considerable risk and should be used only if you're very experienced, and then they should be limited to a small percentage of your overall investments. Also be careful when investing in tax shelters and foreign stocks. It's best to keep your investing simple and basic high-quality, growth-oriented stocks, mutual funds, or real estate. But each is a specialty, and you need to educate yourself so that you're not dependent solely on someone else for sound advice and investments. Chapter 13, 21 Costly Common Mistakes Most Investors Make. Knute Rockne, the famous winning Notre Dame football coach, used to say, "Build up your weaknesses until they become your strong points." The reason people either lose money or achieve mediocre results in the stock market is they simply make too many mistakes. It's the same in your business, your life, or your career. You're held back or have reverses not because of your strengths, but because of your mistakes or weaknesses that you do not recognize and correct. Most people just blame somebody else. It is much easier to have excuses and alibis than it is to examine your own behavior realistically. When I first wrote this book, I came across lots of people who were advising, concentrate on your strengths, not your weaknesses. That sounded logical and reasonable in many situations. But now, after 50 years of day-to-day experience in America's amazing stock market, where every cycle thrusts forward dozens of brand new, innovative, entrepreneurial companies that keep building our nation, I can state this. By far the greatest mistake that 98% of all investors make is never spending any real time trying to learn where they made their mistakes in buying and selling stock, and therefore, what they must stop doing and start doing in order to become highly successful. In other words, you must unlearn many things you thought you knew that ain't so, stop doing them, and start learning new and better rules and methods to use in the future. Difference between successful people in any field and those who are not so successful is that the successful person will work and do what others are unwilling to do. Since the early 1960s, I have known or dealt with countless individual risk takers, from inexperienced beginners to smart professionals. What I've discovered is that it doesn't matter whether you're just getting started or have many years, even decades, of investing experience. The fact is, experience is harmful if it continuously reinforces your bad habits. Success in the market is achieved by avoiding the classic mistakes most investors, whether public or professional, make. Events in recent years should tell you it's time for you to educate yourself, take charge and learn how to handle and take responsibility for your own financial future, your 401k, your mutual funds, and your stock portfolio. These events include Bernie Madoff's theft of billions from supposedly intelligent people through his super-secretive operations, which were never transparent, as he never told anyone how he was investing their money. The public's heavy losses from the topping stock markets of 2000 and 2008, and the use of excess leverage by Wall Street firms that couldn't even manage their own money with prudence and intelligence, forcing them into bankruptcy or shotgun weddings. You can learn to do this. Many people have learned how to use sound rules and principles to protect and secure their financial affairs. Here are the key mistakes you'll need to avoid once you get serious and want better investment results. 1. Stubbornly holding onto your losses when they are very small and reasonable. Most investors could get out cheaply, but because they are human, their emotions take over. You don't want to take a loss, so you wait and you hope, until your loss gets so large it costs you dearly. This is by far one of the greatest mistakes nearly all investors make. They don't understand that all common stocks can be highly speculative and can involve large risks. Without exception, you should cut every single loss short. The rule I have taught in classes all across the nation for 45 years is to always cut all your losses immediately when a stock falls 7% or 8% below your purchase price. Following this simple rule will ensure you will survive another day to invest and capitalize on the many excellent opportunities in the future. 2. Buying on the way down in price, thus ensuring miserable results. A declining stock seems like a real bargain because it's cheaper than it was a few months earlier. Late 1999, a young woman I know bought Xerox when it dropped abruptly to a new low at $34 and seemed really cheap. A year later, it traded at $6. Why try to catch a falling dagger? Many people did the same thing in 2000, buying Cisco systems at $50 on the way down after it had been $82. Never saw $50 again, even in the 2003 to 2007 bull market. In January 2009, you could buy it for $16. 3. Averaging down in price rather than averaging up when buying. If you buy a stock at $40, then buy more at $30 and average out your cost at $35, you are following up your losers and throwing good money after bad. This amateur strategy can produce serious losses and weigh down your portfolio with a few big losers. 4. Not learning to use charts and being afraid to buy stocks that are going into new high ground off sound bases. The public generally thinks that a stock making a new high price seems too high, but personal feelings and opinions are emotional and far less accurate than the market itself. The best time to buy a stock during any bull market is when the stock initially emerges from a price consolidation or sound basing area of at least 7 or 8 weeks. Get over wanting to buy something cheap on the way down. 5. Never getting out of the starting gate properly because of poor selection criteria and not knowing exactly what to look for in a successful company. You need to understand what fundamental factors are crucial and what are simply not that important. Many investors buy fourth-rate, Nothing to write home about. Stocks that are not acting particularly well, have questionable earnings, sales growth, and return on equity, and are not the true market leaders. Others overly concentrate in highly speculative or lower quality, risky technology securities. 6. Not having specific general market rules to tell when a correction in the market is beginning or when a market decline is most likely over and a new uptrend is confirmed. It's critical that you be able to recognize market tops and major market turnarounds coming off the bottom if you want to protect your account from excessive giveback of profits and significant losses. Likewise, you must know when the storm is over and the market tells you to buy back in and raise your market commitments. You can't go by your opinions or feelings. You must have specific rules and follow them religiously. 7. Not following your buy and sell rules, causing you to make an increased number of mistakes. The soundest rules you create are of no help if you don't develop the discipline to make decisions and act according to your historically proven rules and game plan. 8. Concentrating your effort on what to buy, and once the buy decision is made, not understanding when or under what conditions the stock must be sold. Most investors have no rules or plan for selling stocks, meaning that they are doing only half of the homework necessary to succeed. 9. Failing to understand the importance of buying high-quality companies with good institutional sponsorship and the importance of learning how to use charts to significantly improve selection and timing. 10. Buying more shares of low-priced stocks rather than fewer shares of higher-priced stocks. Many people think it's smarter to buy round lots of 100 or 1,000 low-priced shares. This makes them feel like they're getting a lot more for their money. It'd be better off buying 30 or 50 shares of higher-priced, better quality, better-performing companies. Think in terms of dollars when you invest, not the number of shares you can buy. Buy the best merchandise available, not the cheapest. Many investors can't resist $2, $5, or $10 stocks, but most stocks selling for $10 or less are cheap for a reason. They've either been deficient in the past or have something wrong with them now. Stocks are like anything else. The best quality rarely comes at the cheapest price. That's not all. Low-priced stocks may cost more in commissions and markups, and since they can drop 15% to 20% faster than most higher-priced issues can, they also carry greater risk. Most professionals and institutions normally won't invest in $5 and $10 stocks, so these stocks do not have a top-notch following. Penny stocks are even worse. As discussed earlier, institutional sponsorship is one of the ingredients needed to help propel a stock higher in price. Cheap stocks also have larger spreads in terms of the percentage difference between the bid and ask price. Compare a $5 stock that trades $5 bid, $5.25 ask with a $50 stock that trades $50 bid, $50.25 ask. On your $5 stock, that $0.25 difference is 5% of the bid price. On your $50 stock, that $0.25 difference is a negligible 0.5%. The difference is a factor of 10. As a result, with low-priced stocks, you tend to have much more ground to make up from your initial buy point just to break even and overcome the spread. 11. Buying on tips, rumors, split announcements, and other news events, stories, advisory service recommendations, or opinions you hear from other people or from supposed market experts on TV. Many people are too willing to risk their hard-earned money on the basis of what someone else says, rather than taking the time to study, learn, and know for sure what they're doing. As a result, they risk losing a lot of money. Most rumors and tips you hear simply aren't true. Even if they are true, in many cases the stock concerned will ironically go down, not up as you assume. 12. Selecting second-rate stocks because of dividends or low price/earnings ratios. Dividends and P/E ratios aren't anywhere near as important as earnings per share growth. In many cases, the more a company pays in dividends, the weaker it may be. It may have to pay high interest rates to replenish the funds it is paying out in the form of dividends. Better-performing companies typically will not pay dividends. Instead, they reinvest their capital in research and development, R&D, or other corporate improvements. Also, keep in mind that you can lose the amount of a dividend in 1 or 2 days' fluctuation in the price of the stock. As for P/E ratios, a low P/E is probably low because the company's past record is inferior. Most stocks sell for what they're worth at any particular time. 13. Wanting to make a quick and easy buck. Wanting too much, too fast, without doing the necessary preparation, learning the soundest methods, or acquiring the essential skills and discipline can be your downfall. Chances are, you'll jump into a stock too fast and then be too slow to cut your losses when you are wrong. 14. Buying old names you're familiar with. Just because you used to work for General Motors doesn't necessarily make it a good stock to buy. Many of the best investments will be newer names that you won't know, but that, with a little research, you could discover and profit from before they become household names. 15. Not being able to recognize and follow good information and advice. Friends, relatives, certain stockbrokers, and advisory services can all be sources of bad advice. Only a small minority are successful enough themselves to merit your consideration. Outstanding stockbrokers or advisory services are no more plentiful than outstanding doctors, lawyers, or ballplayers. Only 1 out of 9 baseball players who sign professional contracts ever make it to the big leagues. Most of the ballplayers coming out of college simply are not professional caliber. Many brokerage firms have gone out of business because they couldn't manage their own money wisely. In the 2000 era, some used unbelievable leverage. You never want to make excessive use of borrowed money. 16. Cashing in small, easy-to-take profits while holding the losers. In other words, doing exactly the opposite of what you should be doing, cutting your losses short and giving your profits more time. 17. Worrying way too much about taxes and commissions. Name of the game is to first make a net profit. Excessive worrying about taxes usually leads to unsound investment decisions in the hope of achieving a tax shelter. You can also fritter away a good profit by holding on too long in an attempt to get a long-term capital gain. Some investors convince themselves they can't sell because of taxes, but that's ego trumping judgment. Commissions associated with buying and selling stocks, especially through an online broker, are minor compared with the money to be made by making the right decisions in the first place and taking action when needed. The fact that you pay relatively low commissions and you can get out of your investment much faster are 2 of the biggest advantages of owning stock over owning real estate. People can get over their head in real estate and lose money if they overstep themselves. With instant liquidity in equities, you can protect yourself quickly at low cost and take advantage of highly profitable new trends as they emerge. 18. Speculating too heavily in options or futures because you see them as a way to get rich quick. Some investors also focus mainly on shorter-term, lower-priced options that involve greater volatility and risk. The limited time period works against holders of short-term options. Some people also write naked options, selling options on stocks they do not even own, which amounts to taking greater risk for a potentially small reward. 19. Rarely transacting at the market, preferring instead to put price limits on buy and sell orders. By doing so, investors are quibbling over eighths and quarters of a point, or their decimal equivalents, rather than focusing on the stock's larger and more important movement. With limit orders, you run the risk of missing the market completely and not getting out of stocks that should be sold to avoid substantial losses. 20. Not being able to make up your mind when a decision needs to be made. Many investors don't know whether they should buy, sell, or hold, and the uncertainty shows that they have no guidelines. Most people don't follow a proven plan, a set of strict principles or buy and sell rules to correctly guide them. 21. Not looking at stocks objectively. Many people pick favorites and cross their fingers. Instead of relying on hope and their own opinions, successful investors pay attention to the market, which is usually right. How many of these describe your own past investment beliefs and practices? Poor principles and methods yield poor results. Sound principles and methods yield sound results. After all of this, don't feel discouraged. Just remember what Rockne said, build up your weaknesses until they become your strong points. It takes time and a little effort to get it right, but in the end, it's worth every minute you spend on it. America offers a never-ending parade of new, outstanding companies. You can learn to invest with knowledge and confidence to protect your money, and at the same time find and properly handle highly successful companies.